Okay, we're gonna get started. Uh, First of all, thank you everybody for coming to UC LOSF and to this specific event that we have done annually with the team from UCLA Anderson Forecasting. And my name is Evan Epstein. I'm the executive director of the Center for Business Law, which was started here in 2018, focused on corporate and business law matters. And this program has evolved in a very nice way. We mix forecasting, economic forecasting, with some of the cutting edge legal issues. And I wrote down what we have done, at least in the 5 last years. In 2020, we addressed how bankruptcy law could impact firms under the pandemic effects of COVID-19. In 2021, we talked about tech and law post-COVID-19 environment. In 22, we talked about ESG trends, and we had people from the SEC and other companies. Last year, we talked about geopolitics, China, and the future of tech. And this year, guess what topic? AI, right? What else than AI? So we're talking about AI and the future of corporate governance, which is going to be really interesting. We got great speakers lined up, people that are experts in AI from law firms and the companies that are based here in the Bay Area. And I think that is going to make this a super interesting event, coupled with the forecasting from our friends from UCLA in terms of economics, both in the US, in the Bay Area, and California. So we look forward to staying with you until 3 p.m. I know some of our students have to come and go because they also have to take classes. Food is in the back, and thank you very much again for doing this. I want to thank Wilson Sonsini as well, special sponsor for this program, and that's great. And I'll invite Jerry to say a few words for UCLA, and then we'll just get started. So thank you.
Thank you, Evan. It's a pleasure to be here again for this annual conference, our joint conference with UC Law San Francisco. As Evan pointed out, we've had great programs marrying economics and the economic outlook with the outlook for the legal system and how that impacts the economy. So the program, the first part of the program is going to be the economic outlook. I'm Jerry Nicholasberg. I am the faculty director of the UCLA Anderson Forecast and professor of economics at UCLA Anderson School of Management. Again, always a pleasure to be here. Our first speaker on the outlook is going to be Clement Bohr. Clement leads our US forecast team, and he's going to talk about what's happening with the US economy. I will follow that with a deeper dive into what's happening in California. And then we will have Sean Randolph, who is the executive director of the San Francisco Bay Economic Council, who is going to talk about what's happening here in the Bay Area. And you have all of our bios. I'm not going to go through them so we can get to the program quickly, but please read them, particularly Sean's. It's quite an interesting and distinguished career that he continues to have. And before we get started, though, what I'd like to do is certainly thank our partners here at UC Law San Francisco and the Law and Business Institute here, but also our sponsors. Both of our institutions are public institutions. We could not do these programs without our sponsors, and so we are most appreciative of them. And so let me just read them off. At the principal level, RSM and Yamava Resort and Casino at San Manuel. At the platinum level, the law firm of Allen Matkins, California Bank and Trust, Cathay Bank, Clark Construction, Mercury Insurance, and University Credit Union. At the gold level, Wilson Sonsini, Leap Development, and United Airlines. At the silver level, Jackson Square Partners, SMBC Manubank, and Warland Investments Company, and Chip Robertson. And again, many thanks to our sponsors. Now let's turn and find out what's happening in the US economy. Let me turn it over to Clement.
Thank you, Jerry, and hello, everyone. So I'm going to take you through the UCLA Anderson's quarterly forecast that we produced a couple weeks ago. And what I want to do in this talk for the next 20 minutes is just look at some of the economic imbalances that are currently with us in the US economy that were created in the aftermath of the COVID-19 pandemic. And then we're going to look at how these imbalances are going to unwind, and that's going to tell us a lot about where we see the US economy heading. Okay. But before we go there, I want to take a step back and mark what happened about now a month ago in the US economy, which was a very important turning point, which is that the Federal Reserve lowered the interest rates by 50 basis points. Okay, when they did this, they're really signaling now that they feel very confident about having inflation under control and knowing where inflation is headed in the future. So here I've just posted a quote from Jay Powell during his press conference after the FOMC announcement, where he says that our patient approach over the past years has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. Okay, so where does this confidence come from? Well, all we need to do is look at the Fed's dual mandate of full employment and price stability. So in the left plot here, I've shown you the quarterly growth rate of CPI, the Consumer Price Index inflation, over the last couple of years, along with our forecast for the coming 2 years. And what you see there is that all the way back in 2023, inflation had actually already come down and touching 3%. But the Fed didn't immediately cut interest rates. They wanted to make sure it was down for good. And we did have a little bit of a dip up in the start of this 2024 year. So they were very wise to hold off. But then since early this year, inflation has really come down fairly rapidly, very close to our 2% target, giving the Fed this greater confidence. Now, turning to the unemployment rate on the right-hand side, what you see is that, again, going back to 2023, the unemployment rate was very, very low. Now, when I say very, very low, I want to say low relative to what the Fed estimates as full employment. And the full employment, what I've plotted here in the dashed line, is called the non-accelerating inflation rate of unemployment. Now, there's a lot of this measure is very hard to estimate, and there's a lot of uncertainty about this measure. But the important thing is not that it's exactly at 4.4 or 4.2 or 4.6%. The point is that the unemployment rate where we've been, and even with the rise that's happened over the summer in the unemployment rate, it's still a very low level of the unemployment rate. So the last thing I want to mention is that while the Fed is getting confidence about inflation coming down, what you see in our forecast is that inflation rate is actually going to remain above the 2% target over the next year, and first hitting the 2% target in 2026. So why do they have this confidence? Why is it taking so long for inflation to come down? Well, that's if you decompose to look at what's actually driving inflation, all of the excess inflation we have now, or nearly all of it, is coming from rises in the cost of shelter, the cost of housing. Okay. Now, so that means that that most of the prices today in the US economy are actually consistent with the 2% inflation target. But this large turquoise bar here shows you that there's still too much inflation in the housing sector. And that news is actually good news, because the cost of shelter inflation is rising so much now, not because of current inflationary pressures in the housing sector, but because of past inflationary pressures in the housing sector. So here, the turquoise line is the same measure as what I showed you in the left-hand plot in the turquoise bars, and it measures the CPI shelter index. That's the average inflation rate of the average cost of housing right now. So if you take everybody who signed a contract for a new lease on an apartment 2 years ago and is still going on that contract, and everybody who signed a lease recently, and you take the average over all of those, that's the price level at which this measure is growing by. And if you contrast that by the dark line up here, which shows you the inflation rate of current market rates, right? So not just the average rate in the economy, but what the rate would be if you actually go out and rented a new apartment right now, what you see is that spiked during the inflation, but is now actually back down to its long run rate. And so the reason why the CPI shelter index is above that is because it still has a lot of catch up to do. There's a lot of these old leases that have signed a long time ago that still need to be updated and be caught up to the current market rates. And so that's what's going to take a long time to, or not a long time, but another year or so to unwind until we've gotten all of this inflation that happened during the pandemic in the market in the housing market into the actual CPI price index. So with that in mind, what does that mean for where interest rates are headed in the future? We already saw that the Fed lowered interest rates by 50 basis points. And what we have in the next two upcoming FOMC meetings in November and December is another two cuts, one cut of 25 basis points in each. And then after that, there's going to be a more gradual pace in 2025, about 25 basis point cuts per quarter. Right? And that's going to feed into long-term interest rates, but it's not going to feed in directly as some people initially estimated, because when the Fed cut the rates last month by 50 basis points, they also at the same time signaled that they were going to have a much more aggressive path of monetary easing forward. So even the short run rates over the next couple of years were revised to be lower over that time, as they said they were going to cut rates by more than what they had previously said. And in response to that, the 10-year Treasury bond and other long-term securities those rates actually went up. Okay, so there's the signal of the Fed signaling to the economy that they really had inflation under control, that there was a much higher probability of a soft landing, meant that there was a lot greater confidence in this economy going forward, and it's going to have a lot stronger growth over the next couple of years, which actually led to higher interest rates in expectation going forward. So as you can see in the thick line in the graph, these longer term interest rates, and here I'm just plotting the 10-year Treasury, have already fallen by 1 to 2 percentage points over the last half year to a year. But we don't actually expect it to fall much more than that because the economy is doing so strongly. Okay. So that takes us to our headline numbers. This past quarter that we just went through, the third quarter of 2024, is looking like it's going to be another very strong quarter of GDP growth. We know that based on the data that's come out month by month in retail sales and consumer expenditures and industrial production and durable goods orders. We do then expect there to be a slowdown in GDP growth for the fourth quarter of 2024. But then in 2025 and 2026, a real rebound with very strong growth in the mid-twos going forward on average after that. And so what are these near-term headwinds going into 2024? Well, you probably read a lot about them in the news recently. First, we've had two fairly systemic strikes. The good news is that since this forecast has come out, one of these strikes has already been mitigated. The East Coast dock workers strike only lasted a couple of days. It's not quite settled yet, as there's still some discussion going until January about how much automation the union is going to allow to happen at the docks. But the bad news, on the other hand, is that the Boeing strike has been going on for about a month, and it's taking a large toll in Boeing, and there's no end in sight. And Boeing has just announced last week that they need to cut their workforce by 10% permanently. And the last point I've written up here is the presidential election. So it's not the presidential election in and of itself, but it's the uncertainty about the outcome around it. And when there are these elections that go on, firms tend to just temporarily defer their investment and business expenditures until this uncertainty is realized, and then afterwards picking it up again. All right. So this is also feeding into the fact that we just are expecting just a temporary slowdown that'll then pick back up again in the new year. So going into 2025, we're going to assume for the forecasts and what I showed you in the past graph that all these issues, all these slower near-term headwinds are going to be resolved smoothly, but we're certainly not going to predict the outcome of the presidential election. Okay, as you all know, this is a very close 50-50 toss-up election, not just for the president, but also for the Senate and the House. And so for this forecast, we're going to assume gridlock going forward, as there is a fairly large chance that not all the different chambers of the Senate, the House, and the presidency are going to go to the same party necessarily. So with the rest of this talk, what I want to do is talk about these current economic imbalances and how, when these are going to unwind, they're actually going to boost growth in 2025 and 2026 going forward. I'm going to spend most of the time talking about the housing market, and then I'll talk a little bit about the auto market and also how household consumption patterns have changed since the start of the pandemic. And it's really worth noting just how much of a wild ride the housing market has been on since the start of the pandemic. Right when the pandemic hit, we all shifted to remote work, and that greatly increased the demand for housing and space among workers. That increased demand was then amplified by the fact that we had a huge amount of monetary easing with interest rates or mortgage rates going down to 2.8%, a historic low. And then in 2022, we then had this whiplash in mortgage rates where they then they rose up to just above 7%. Okay, so that really led the housing market to fall off a cliff, and I'll talk a little bit more about that in the next graph. But now we've even passed that, and now we see mortgage rates slowly coming down through 2024. So with the second whiplash in mortgage interest rates, that's what I'm showing you here on the left graph. I have two lines. The first one is the gray line, and that's the average mortgage rate on current existing mortgages. So that's, again, that includes mortgages that were signed and are in action that were maybe from 5 or 10 years ago that are still being paid off, as well as mortgages that were, say, just under contract last year or just signed this year. Now, the black line, in contrast, is the current going rate for mortgages in the US. And so what you see is that both of these were declining over time. And the actual current market for new mortgages on average hit down to 2.8%. But then immediately after that, we had this sharp rise in interest rates and mortgage rates, which led to the fact that on average, the market mortgage rate was 3.2 percentage points higher than the average mortgage rate for the average US household in the economy. Okay. And so I have this term golden handcuffs written up there. This is the idea that if you're a household and you have a current mortgage, which has a much lower rate than what you can get in the market, even if you want to move because, say, you need a bigger house or you need to get closer to work or you have more kids, it's financially very tough for you to do that, and you don't want to move because your current mortgage is so much cheaper than the one you could get if you have to go and move and get a new mortgage on the market. And this mortgage whiplash right here has essentially made that happen for the entire US economy. So what I'm showing you here is the share of existing mortgages with rates above and below the current mortgage rates in the market, with green being the mortgage rates above and the purple being the mortgage rates below the current market mortgage rate. And what you see is that, throughout the past 20 years before the pandemic, it fluctuated, but there was a fair amount of people both with mortgages on average below and above the current market rate. And then because of this sharp rise in mortgages after falling for such a long time, now essentially the whole US economy has mortgage, or all the homeowners have mortgage rates that are lower than the one they could currently have. And so that really led to this steep fall off in existing home sales in the US economy. And that's what I'm showing you on the left plot here. So this is sales of existing homes. And what you first see from 2020 to 2022, we had this huge boom because of the first part with the increased demand for housing and the very low mortgage rates. But then as these mortgage rates sharply shifted higher, you see this amount of sales just fell off a cliff. And they actually fell to levels where we're at right now, which are at the same levels as were true during the Great Recession. So like really, very low levels. Now, since mortgage rates have started coming down, and hybrid work is not going away, it's settling or stabilizing at about 50% occupancy relative to before the pandemic. And we also have an incoming group or cohort of home buyers, which is millennials in the early 30s, which is the largest segment of the US population that's going to increase the demand for housing. All these three factors are going to converge to lead to a rebound in residential investment and a rise and a normalization of existing home sales and new housing starts going forward. Turning to vehicle sales, what you see here is the amount of vehicles sold annually since 2017. And what you first see is the huge dip during the recession, and then in 2021 through 2023, you see another dip, which had to do with the shortages for microchips and the lack of vehicles on the market. But then that didn't recover. So since we don't have any shortages of microchips and inventories of cars anymore, but we still have suppressed levels of vehicle sales than we did before the pandemic started, right? So you see before the pandemic, we had about 17, 18 million units of sales a year. We also had that back in the 1990s, but we can't get up there again. And so what's holding vehicle sales low, especially considering the rest of the economy is doing so well recently? And there's a couple factors to that. One is the fact that the vehicle industry is transitioning right now from combustion engines to electric vehicles, and that's a very hard transition to gauge in terms of production, as it's very hard to estimate the amount of demand there is for this new market. And they may have, in fact, overestimated the demand for new electric vehicles because there's been a huge buildup of electric vehicles inventories. But another reason for the fact that we have this subdued level of inventory of vehicle sales is the fact that vehicle prices sharply rose during the pandemic, and they're still very high relative to the rest of the economy and where they have been in the past. So one thing I want you to note about the graph on the right is that the price index for new and used motor vehicles was indexed to 100 back in 1997. Okay, so I'm not showing you that far back, but what you do see is that up until 2020, that value was still 100. When you take into account the fact that on average, the price level and wages rise over time, that means that the price for a new vehicle for an average consumer actually falls over time as we get better and more productive at producing vehicles. Then what happened during the pandemic is that there suddenly was this nearly 30% rise in the price of vehicles, and it hasn't come down very much. Okay, so what we forecast going forward is that as these prices slowly normalize and come down, the vehicle sales are slowly going to rise up to levels more consistent with what they've been in the past. And the last thing I want to talk about here is household expenditures. The pandemic really changed the way our expenditure patterns, such as in the beginning, we essentially were forced not to consume anything in terms of restaurants and services and concerts as the lockdown. But that, and I don't show you that here, what I'm showing you on the left-hand plot is the consumption of durable goods, such as Peloton bikes and cars and other furnitures and the like. And what you see is that most people switch their consumption expenditures from services over to durable goods. But since then, our consumption of services has rebounded and reconverged back to where it was in the past. But our consumption of durable goods has not done the same thing, right? It's remained highly elevated. And so how can we have the same level of services consumption as we did before, but a very highly elevated level of durables consumption? Well, just by spending more, right? And so how have we been funding this spending? Well, we had a lot of pent up savings from early on in the pandemic and due to the fiscal stimulus that happened during it. And then starting in 2022, we started dipping into savings and also taking on a lot more debt and credit, which is why you see these very low savings rates after the pandemic on the right-hand plot. And so we don't forecast this to change going forward very much. We're expecting, for one thing, you see in the graph that there's no trend in the converging of durable goods, but also because the housing market is going to rebound, that is going to take with it a lot of the new demand for durable goods to, furnish those new houses. And so what we forecast going forward is this very low savings rate going forward, while in 2026 it's going to start going back up to more sustainable levels. So with that being said, to conclude and review what I just covered with you, both inflation and unemployment are near the Fed's target, and the economy is looking close to being in balance. The U.S. economy in this past quarter grew very quickly again. We do expect a temporary slowdown, but not too much of one, but just a slight one in the fourth quarter of 2024, but then fairly robust growth going forward over the next 2 years due to a rebound in the housing market. Okay, thank you.
Thank you, Clement. And now we're going to turn to California. And of course, this is a political season, and we hear lots of things being said about California. Some of it related to the fact that California's population hasn't been growing, and we've had an outmigration, maybe not this year, but in recent history of quite a few Californians. So what I want to do is continue this theme of growth in California, but also adjustment to the new reality. And I want to talk about housing, about tech. So I've got an image here of Silicon Valley, Hollywood, and education. California's unemployment rate is 1.1 percentage points above the US. So this is one of the highest unemployment rates in the country. And that's one of the things that folks in the political realm are pointing their fingers at. What we want to do is look at data and try and understand what's going on here, and is California really the new Rust Belt, or is it something different? So the roadmap for today, we're going to look at GDP. So if a state is declining, you expect GDP to decline. So we're going to take a look at that. And then we're going to look at employment and strengths and weaknesses in the California economy. And then finally, the forecast or the outlook. So let's start with GDP. What you see on the left-hand panel is GDP growth by state from the first quarter of 2019, pre-pandemic, to the first quarter of 2023, post-pandemic. These are the 23 largest states, because when you get to state number 24, it really is so small in terms of economic output that it doesn't move the needle. What do I mean by that? If we think of Delaware, if Delaware grew at 10%, at a 10% annual rate of growth, which would be amazing, you would never see it move the needle for US GDP. So these are the states that actually matter for US GDP. All the way over on the right-hand side in the light blue is the US. And then you have kind of the usual suspects here of Florida and Texas and Colorado, but California actually was growing faster than the US through this entire period. And this is a period when 500,000 people left California. On the right-hand side is sort of the more recent data. So that's the second quarter of 2023 to the second quarter of 2024, the latest data we have available. California moves to the left, Texas moves to the right. Interestingly, in this political season, Georgia and Wisconsin actually are now growing faster than the US. But there are two ways that you can get growth in GDP. One is to have more people, right? You have more people doing stuff, creating goods and services, you get larger GDP. That's why China has the second largest GDP in the world, but it's still a very poor country. And the other is you can have increased productivity, increased wealth, increased income. And we have a lot of migration in this period. So let's try and take that migration out and see what's happening by looking at per capita growth in GDP. And that's going to be the left-hand graph here. So per capita GDP growth from 2019 quarter one to 2023 quarter one was the same graph that you just saw. California is the fastest growing large state in the US. So what is happening here is that we have a churn in California in which larger families and families or individuals with fewer skills not being able to command as high an income have moved to other states because it provides a better opportunity for them. If we think about here in the Bay Area, if you want a large family or if you are a low income earner, this is a very difficult place to live, right? This is all of our discussion about affordability of housing, particularly in coastal California. But when they leave, they open up a housing unit for someone to move in, someone who actually can, because of their earning power, afford this coastal California lifestyle, and that increases average productivity, right? So that's what we're seeing here. That California is not imploding, but it is changing. But we do want to, come back to, well, this higher unemployment rate and the fact that the latest numbers, for example, in the second quarter of 2024, California grew at 2.8%, the US at 3%. So they're just about the same, statistically, they're probably the same, but California is used to growing faster than the US. So what is going on? Let's dig into the employment numbers. You see two lines here, a blue line and a red line. And the blue line, let's talk about that first, is one measure of employment. It's called total employment. It's from the household survey. So it's a survey of people based on where they live. And this is where we get our unemployment numbers from, right? So the Bureau of Labor Statistics will call up and ask folks, are you employed? Yes. then you're in the labor force. Are you not employed? Are you looking for a job? Yes, you're in the labor force and considered unemployed. That's the blue line. And you notice it doesn't come back to its pre-pandemic peak. The red line is non-farm payroll jobs. And so that is where people work. It's a survey of enterprises. It's a much larger survey and a much better survey than the blue line, but the blue line gives us our unemployment numbers. One thing we can do with the non-farm payroll jobs is we can look at sectors, which we can't do with the blue line. But it's worthwhile to say what's in one and not the other because they kind of look a bit different. So in the blue line total, but not in payroll employment, is farm workers. And we've had a fall off in farm workers because of the wet winters that we have. If you've driven down to my part of the state on the 5, you've seen Tulare Lake, which wiped out a whole lot of farmland. We have independent contractors and gig workers and family members who are working in family businesses. And think of, family restaurants that have gone out of business over the last few years. In the red line, the payroll employment, but not in the blue line, are remote workers working out of state. So if someone has a job here in San Francisco, but they're living in Boise, they're in the Idaho labor force, but they're going to appear in the red line as working in California. And so that's one thing that's in there. The other is undocumented workers who have brought fake documents to work so that they can work. So they're certainly not telling the government that they're working, so they're not in the blue line. But from the enterprise point of view, they certainly are working because they're being the regulatory reports for payroll taxes are being submitted and counting them. So there's a real difference here. And you notice the red line, payroll employment, is greater than its previous value. And, one of the things that we see at UCLA, there's a freeway that many of you might know called the 405. It's always been a parking lot. 500,000 people leave California. It's still a parking lot, right? So that is the increase in employment and kind of anecdotally gives us more confidence in that red line than the blue line. But let's just kind of break this down as to where we've lost jobs. And this is by sector. I'm going to color code this. This is scientific and technical consulting. So this is tech. And then we have Hollywood, broadcasting and content creation. And this is real estate agents and brokers. So that's housing. We're going to talk about that. Software publishing, that's tech. Credit intermediation, which is at least in part related to the housing market. Scientific research, so we're back to tech. This one is employment services. And that's where temps live. And typically in a good economy, this shrinks as temps are offered payroll jobs. Non-durable goods manufacturing, so we want to talk about that. And so we're not going to talk much about that. That's a long-run secular trend. This is things like paper production. It's not just California, it's nationwide. But the next one we want to talk about computer and electronics manufacturing. We'll start with that and look at these sectors and see what do they tell us about what's happening in California going forward. So first, durable goods manufacturing output in California. We think that it's all gone to China, but it's 21% above 2018. So this is a growth in manufacturing in California. But that pullback that you saw in the last graph are those last two bars there where if we just did the line to that, it's only a 14% growth. 14% growth is pretty good, but it means it's a recent pullback. Are we concerned about that continuing? And the answer is no. And I'm going to show you some pictures. This is anecdotal, but it's happening all over California. And what you notice here, we're just going to go starting on the upper right-hand side and go clockwise. We have Tesla, which is building an energy storage factory, a large energy storage factory in Lathrop. And certainly Tesla knows about Nevada and Texas because it has factories there. The next one is Scorpios, that's moving out of Texas to Temecula in Riverside County. The semiconductors, and then we have Pacific Steel, a new steel factory in Mojave in Southern California, and also in the high desert in Southern California. We have aircraft production that's expanding. In the picture here is the B-21, which is a minimum $80 billion manufacturing process. Then Evercharge up here in Hayward, and Bosch with semiconductors in Roseville. So you notice that the majority of these are in that subsector of electronics and computer manufacturing that declined in the last 2 quarters. But these are going to open up over the next 2 years, and employment is going to increase. But this is advanced manufacturing. So it's not going to be the same level of employment as you might have experienced when Rosie the Riveter was going into the factory. But we're not really concerned about that. It's not going to be a dynamic growth area. One of the things but it is going to be a growth area. And one of the things that you notice is that most of these factories are inland, where land is less expensive than here on the coast. Now turning to tech, there is no real tech sector. So we have to infer that from sectors that are tech intensive. And you see here professional, scientific, and technical services. It increases, kind of drops off in the lockdown, then increases to record levels, and then you see kind of a pullback, and that's the tech layoffs we heard about, but now it's stabilized, and as tech has been growing, those unemployed tech workers are going to be absorbed. Let's look at another measure, and this is computer services. So computer tech is the way I've labeled it. It looks pretty much the same, right? And we're not concerned about that because, as you all know well, we have AI and a lot of venture capital money moving into the Bay Area, but also into Los Angeles, Orange County, and San Diego. So tech is still a growth area. And if you look at kind of the distribution of venture capital money, it comes to California, New York City, and Boston. And that's about it. As much as we've heard about the new tech centers in Austin and Nashville, et cetera, the venture money for tech is coming here. So let's turn to housing, and what you see on the upper left-hand side is what Clement showed you for the U.S. housing sales. So this is single-family homes. Sales in California has fallen off a cliff. It is at depression levels. But now the graph that's just below that is housing prices. This is the median home price throughout the entire state. And there's some compositional things because it depends on what's being sold to give you the median home price. And it's backed off from its previous 2 peaks, but it's still very high. And we know that because we hear about the lack of affordability in California. So if you have high home prices and not much existing inventory, that means that builders can make their business plans work. And we have a number of new initiatives, new laws that came out of Sacramento, making it easier, not easy, but easier to build in California. But if you look at the graph on the right-hand side, what you're looking at is new residential permits. And it's been growing, kind of move your eyes to the right-hand side, it's been growing, but it's still, pretty lackluster. This is a kind of a slow growth. We're expecting a lot more growth as mortgage interest rates have come down and with these new bills going into force, but it's not there yet. And so that's also part of the weakness that we've been seeing in California over the last year, is that housing is yet to take off. But there is some real good news in the development of commercial space, and that is that retail has now turned a corner. So what we see here is the Alan Matkins UCLA Anderson Forecast California Commercial Real Estate Survey, and this is a forward-looking survey of 3 years. The scale is 0 to 100 is divided by the dashed line at 50. Above 50 is developer optimism that the markets are getting better and they're getting ready to jump back in with new developments over the next 3 years. And below is pessimism. And we've been tracking this over a number of markets, and it turns out it's a very good predictor of developer behavior. So all the way over on the left is San Francisco, and I think that's not a surprise because of the high percentage of office workers who are now either remote or hybrid, and also because Asian tourists really haven't come back in a big way, particularly Chinese tourists, to San Francisco. But then moving across the East Bay, Silicon Valley, Sacramento, and San Joaquin, the Delta area, LA, Orange County, San Diego, and the Inland Empire, all optimism. We're seeing the beginnings of new development in retail. What it also says is, if you look at kind of a big gap there, is that when a sector like office ends up turning down, it's going to take about 4 to 5 years before it starts coming back, and retail has just started coming back. We're expecting growth in commercial real estate over the next 3 years, except office. And we'll talk about Hollywood for a few minutes, although that's a good bit south of here, although some of the entertainment industry content is done here in the Bay Area. But the graph that you see is days of filming in Los Angeles, and the blue line is feature films, and the orange line is television and streaming. And the important thing to note here is, I think, best illustrated by the top line, because the blue line, you see by the way, the yellow is the COVID lockdown, and the gray are the 2 strikes in Hollywood. But the important thing to note is that feature films, a little bit of decline, but not much. But on the orange line, after COVID, you see a big spike because of catch up, and then it starts coming down. It comes down pretty sharply. Notice the history of labor actions, that they are not surprise events. So people stockpile, they get ready for them. There's no stockpiling going on here. And in the previous writer's strike, we saw a stockpiling by studios, not happening here. You go through the strike, and then to the right of that gray line, what you see is a little bit of recovery, but not much. So if you extrapolate out at that average, you see a big cutback in content production. And that's what we're hearing, of course, anecdotally from the studios and from Hollywood. What this means and why this is important statewide is that about half of the people who work in Hollywood are independent contractors, which means they were in the blue line for employment, but they're not in payroll employment. And there are a large number of people who've been working in entertainment who are not going to get their jobs back, and they're going to have to move to another sector. But that gives us part of, and it's about 4/10 of those 1.1, 4/10 percentage points of that 1.1 is resident right here. And so that explains part of our higher unemployment rate. So finally, some sectors of concern. Those people who moved out with larger families and the declining fertility rates means that K-12 education is shrinking. And that's evident in the left-hand graph. It's going down. We have excess resources in K-12 education at the level of resources that we had per student kind of prior to this downturn. And that means particularly support personnel and administrative personnel are going to be, if not already, unemployed and have to move into other sectors. And on the right-hand side, we have a lot of things delivered during and immediately after COVID. And we're not doing that so much anymore. One of the reasons why retail has come back to the surprise of many, is we want to be around other people. So we're going to stores. We're not having as much delivered, and as well, the cost of delivering as deliveries are going up. And so we had a large number of people, independent contractors, again, in the blue line, not the red line, who are unemployed, but not going to be reemployed in the delivery part of the economy. So they're also going to have to move elsewhere. So to summarize, manufacturing and tech, recovering in 2025 and 2026. Construction, real estate, and agriculture also recovering, but at a much slower rate. Entertainment, education, careers need to adjust to the new normal. So that's going to keep our unemployment rate elevated for a little while. 2024 is atypical. California growing at or slightly slower than the US, but we return to normal, higher than the US in 2025. But there are risks, and I think these are all familiar to you all, but it's really bears worth repeating. Housing and homelessness, particularly in our urban centers, urban public safety, climate change, I have here as drought and deluge, and shutdown of the China trade. If policy in 2025 or 2026 really ramps up the tensions between China and the US, the economic tensions with very high tariffs, for example, that's going to affect supply chains and logistics and will very much adversely affect California. So these are things to keep our eyes on. And just a couple of numbers here to finish up. Payroll job growth is in 2025 and 2026 picks up. That's that recovery that I was speaking of. And the unemployment rate comes down to 4.4%. So we're looking fairly normal, kind of a lot like 2019. But when it comes to housing, a much slower build, but a much slower build, getting to 127,000 units in 2026. And by the way, that is nowhere close to making a dent in affordability. And that brings me to the end of California, so thank you. And now let me invite up my friend and colleague, Sean Randolph, who's going to drill down on the Bay Area.
Good afternoon, everybody. I'm going to bring us down, as Jerry said, to look at where we are, look at the Bay Area, what's going on. And I think what you'll hear is broadly consistent with what you've been hearing about California, but with a particular Bay Area flavor, especially around events in downtown San Francisco and, of course, the technology sector. And I think consistent with what we've been seeing in the last several years, in the past, you could see pretty much a single narrative. It's great. Post-pandemic, we've had really conflicting narratives struggling for dominance, one positive, one negative. The reality is we still have these conflicting narratives. You can tell a good news story, you can tell a bad news story. And the question is, what's the trend? I think overall the trend is positive, but much slower than we would like. So let's get into it a little bit. I know how to work it. Which way? The right arrow. Oh, there. Okay, here we go. Around the way. Okay. So looking at jobs, in the Bay Area, we've continued to lag both the nation and the state of California in achieving sort of break-even point in employment for where we were before the pandemic. So we're still about 1.4% down from pre-pandemic levels. California has done better, the US has done better. And a lot of that in this region is because of technology company pullbacks. We've been seeing significant scale cutbacks by most tech companies and now by a fair number of biotech companies as well. Early on, post-pandemic, it was because they just massively overhired and they needed to kind of normalize that. They overshot the mark. I think now it's much more financial pressures normalizing the workforce in different ways. So I think the underperformance on job growth is primarily due to what's going on over maybe about a 1.5 year period now in the tech sector. You know, that said, we're doing pretty well. Unemployment rate in the region is about 4.1%, which you know, is pretty good historically, at least on a national level. But we have a way to go on that. We've seen over the last year growth in a lot of local serving jobs, especially in the service sector. You've got education, government employment has recovered, retail trade has actually recovered some. Leisure and hospitality has recovered. That was a big hole the last couple of years. And now I think we're seeing more tourists coming back, more conventions coming back. It's still a difficult one for San Francisco, though, because Moscone Center is bookings are way below what they were before the pandemic. They have not improved to the level where Moscone is generating anywhere the number of hotel occupancy rooms as they had several years ago. So I think that the leisure and hospitality sector in the Bay Area, especially the city of San Francisco, is still in negative space. Hotels are certainly feeling it. There have been quite a number of large ones in foreclosure, trading hands. But nevertheless, I think as tourists have returned, we've seen employment coming up from what it was during the pandemic. As Jerry mentioned, the hole in that donut is Asian, especially Chinese tourists. We have North American tourists. Yeah, you can find European tourists pretty much everywhere. Some Japanese are back late to the game. The Chinese are beginning to show up, but because China shut down completely for so long, as they started to travel, they tended to travel mostly in Asia and are only now finding their way back to the US, but they're starting to show up. So that may be a good trend. But then again, we see the areas on the right, the brown part, the red part, where we've seen construction still in the negative side, manufacturing down, and information. Of course, that's really where we've seen loss of jobs recently in the tech sector. So if we look at tech, because a lot of this has to do with tech, the region still has the highest concentration of tech companies and tech employment in the region by a very significant margin. Other areas, however, are growing faster than we are. So you can see Austin is growing quite fast. In the Bay Area, it's still nothing close really to the Bay Area. But if you look at scale, the Bay Area still has by far the most scale. But you do find faster growth in other regions, often regions that companies and workers moved to during the pandemic. Which gets us to this question that's kind of in the media a lot about Texas. Should we be worried about Texas? And how are we doing in California, the Bay Area, compared to, say, Texas and Austin? So there's some interesting things going on there. Our research at Barry Council Economic Institute has shown that typically if companies leave the Bay Area, they move their headquarters out of the Bay Area, it doesn't mean they leave the Bay Area. In fact, in most cases, they have just as much employment here as they did before, and they continue to hire robustly here as they did before. The darker side of the narrative is if they leave the Bay Area, they tend to grow their employment more elsewhere. So if they were just here, they would have grown their employment more than they are. If they move their headquarters, they tend over time to hire more in the place they've moved than they do here. So that's a bit of a problem. There are some interesting dynamics right now. This really began earlier this year, late last year, however, around the tech economy in Texas, with which we're all most often compared. So there was just a recent report by Placer AI showing that there in the last year has been negative migration from Texas. In other words, a lot of people are moving into Texas. Now net, there are more people moving out of Texas. And if you look at real estate values in Austin as maybe one indicator, we've seen real estate value is falling in Austin, primarily for two reasons. One, there was a lot of enthusiasm for Austin and developers came in, as often happens, and they just built a lot of office space, they built a lot of housing, and they probably overbuilt. And so I think they overshot the mark in development. But then again, I think the migration of people from California into Austin has slowed a lot. And now there are actually more people leaving Austin than were coming in recently. So I think we've seen probably, not that people aren't going to continue to go to Austin, there's a lot going on there, but I think we've seen the peak of the out-migration wave from the Bay Area to places like Austin. And that will probably continue on into the coming year. If you look at, I think Jerry mentioned venture capital, it's really kind of a day and night story in terms of venture capital as a stimulant for innovation and technology growth. So since 2018, there was about $427 billion in venture capital raised here in the Bay Area, primarily invested here, about $26 billion for Austin. So that's about a 1,500% difference in venture capital between the two areas. And that kind of explains why we're seeing a lot more tech company, small, medium size, scale up growth in the Bay Area versus Texas. What we're finding also, this is largely anecdotal, but I hear it again and again and again from people I know, is that a lot of companies and a lot of individuals who left the Bay Area over the last, say, 3 to 4 years during the pandemic for, say, Austin, are doing one of two things. Of course, some of them are just staying there, but quite a number are either returning, just moving back to the Bay Area, or they've decided they actually can't leave the Bay Area entirely. They need to allocate more time and more resources here. So there are people who are actually coming back. These are not huge numbers, but net they're coming back. And if they're not coming back entirely, they're splitting their time. So maybe they were all the time in Austin. Now they spend 50, 60, 70% of the time back here in the Bay Area because they just can't leave it. Just the density of activity is really no comparison. So I think for workers, this raises an interesting question, and this really relates to downtown office vacancy and occupancy in San Francisco, which is what's the effect going to be of return to office mandates by companies? We've known for a couple of years, companies in general want their people to come back. They haven't generally forced the issue. For several years, the leverage was on the employee side. People were in short demand, companies didn't have much leverage. And then with the tech layoffs started a couple of years ago, I think the balance of leverage shifted. And with more and more people being let go by tech companies, if you lose your job, you are not necessarily assured anywhere as easily as it was before that you would be rehired by somebody else anytime soon. So if you were one of the, say, let's say, of the people who left Silicon Valley and San Francisco during the pandemic, probably 75% never left California. They went over the hills to the Central Valley and other places where housing was cheaper, but they could drive in here in an hour and a half or maybe 2 hours. So for them, the return to office is not a big deal. You come in a couple of days, maybe a few days a week, you can do that. For those who went to Texas, those who went to other places, maybe they went to Nashville, maybe they went to Florida, they've got a choice. Do they say, we made our decision, this is where we are? Or if their company in the Bay Area says, we want to expect you to be back, and by the way, that's going to be reflected in your employment and your opportunity for professional advancement and ultimately whether you're employed in this company, they have to decide, do they come back or not? And I think we're seeing the beginning of a trend where those people are starting to filter back as companies, say Salesforce being one big example, the largest employer in San Francisco, as they start to say, no, we want you here, and increasingly they're starting to say 5 days a week. So it'll be interesting to see over the next year now what the trend will be as companies actually begin to get more serious and enforce a return to office mandate, and how that affects especially things like occupancy of commercial real estate. This is pretty similar to one of the slides that Jerry showed, which is if we kind of follow over a longer period of time, say 2011 up to the present, the growth rates for the Bay Area and for the US, we're kind of in a similar pattern to what we've been for a long time. For many, many years, we had a significantly higher growth rate here in the Bay Area than in the US as a whole. Both of them plummeted briefly during the pandemic, and now we've seen kind of a similar trajectory for the Bay Area and for the US. So that makes us think that what we're doing right now is that this is kind of an economic and a business correction. It's not a major structural change that we've been going through or will go through. So I think what we see every day here kind of reflecting this difficult transition out of the pandemic is real estate. You know, you walk around downtown San Francisco, you can feel that it's a lot quieter than it was. So pre-pandemic, the vacancy rate in the city was about 4%, which is effectively almost zero. The rate today is about 37%, and it really hasn't changed since the beginning of 2024. It was about 37% then. So we've seen this rate be really high and sustained at a high level, and it actually could go up a little bit early in 2025. But there is some reason to think that it may have peaked, and that although slowly the metrics for real estate in the city, we're talking about commercial office space right now, may be turning a corner. One data point would be that in June, after going up pretty much every month for about 3 years, the inventory of property on the sublease market actually fell. So if that is sustained, that's one indicator that says, okay, we're starting to see some positive absorption of what has been vacant space. Another interesting trend is we've seen over the last year a lot of large commercial office buildings. They're typically not the grade A ones, lower quality buildings have been selling. And typically for maybe half of what they had been purchased for pre-pandemic. So if you go back 5 or 7 years, if you owned a building then, if you bought a building then and you sold it this last year, you would have probably sold it for maybe 60% or as low as 40% of what you bought it for. So that's tough if you own the building. On the other hand, if you are looking to get in the market for real estate and jump in on low prices, whereas we are seeing these buildings being bought. These are people who are acquiring the properties and they're betting on the long term. They're betting on the longer term recovery of San Francisco and other downtown areas like San Jose. And so there is definitely positive interest in the market. And again, it's a long-term play. The medium-term play. We're seeing some interesting trends also in rentals. And this is kind of bucking a US trend where rents have been going down. In September, the rent for one-bedroom apartment in the city here was about $3,100. 2 bedrooms was about $4,200. The rental rates for both those kinds of properties went up 6% last year. So that makes San Francisco rent, we're talking about San Francisco, one of the very highest in the nation, maybe in the top 3 cities or so in the nation. So that reflects a couple of things. It reflects a lack of new building. There's no secret that we don't have enough housing, and we have not in the last several years, including last year, been building anywhere near enough housing as we need. So that's part of it. But part of it also is what we were talking about just a moment ago. The return to office mandates, meaning, well, more people are going to need and want and are locating in downtown areas or areas close to their place of employment. And again, we're starting to see signs of a remigration of people from other parts of the country who had left the Bay Area back to the area, back into the Bay Area. So that's an interesting trend around rents as well. And here you can see the office buildings, the larger buildings that have turned over in the last year. And again, the price per square foot is a lot lower than it was pre-pandemic. These buildings are generally going at a bargain. Some are vacant, but actually some are leasing up very rapidly or are fully leased. So I think this is the trend. The buildings are staying, they're not staying on the market that long, and people are buying them. And if you're a company, say a startup, a tech startup that wanted to be in San Francisco and you just couldn't afford it because it was crazy expensive, you know, it's pretty easy to find space in the city now at a very reasonable rate. So we're seeing tech companies taking new leases. We're seeing younger tech companies, you know, startups, scale-ups taking new leases. We're seeing a lot of tech and other leases being renewed, but the twist with the renewals is very often it's for less space than before because nobody expects that everybody is going to be back in the office 5 days a week for some time. And so they're staying, they're renewing leases, but for less space. So popping up to a high level again, sort of some of the macro trends, but thinking about the positive side where momentum is really happening in the economy here, because I think the momentum is swinging in a positive direction on employment and on commercial office space, where we're moving in the right direction very, very slowly. But a lot of underlying problems that need to be worked out still. On the plus side, this is the positive narrative. Of the 50 largest US companies by market capitalization, 17 are local companies. 5 of those are in the top 10 companies nationally. So if you look at the dark blue bubbles, those are the Bay Area companies. One thing you'll see there, these are pretty much all tech companies, one way or the other. I think Visa would call themselves a tech company, a fintech company. But it shows where both the capitalization and the revenue for companies in the region is overwhelmingly led by tech. And the size of the bubbles has been changing. If we looked at this a year ago, the bubble for NVIDIA would have been a lot smaller. Now the bubble for NVIDIA is really big. It's number 2 here in the region. So it shows the importance of tech to the economy still. And whatever else has been going on in the economy with the pandemic, you can see just the value being generated by these companies, just the growth. Again, this is measured by market capitalization of the companies. Apple, NVIDIA, of course, 1,700% growth for NVIDIA, but you look at Google, you look at Meta doing very well, Broadcom, and a lot of others. So again, we're seeing lots of value continuing to be brought to the region by these very large companies that are continuing to grow. Looking at the smaller companies, and this gets us a little bit back in the Texas and Bay Area conversation. Looking at what's the role of the Bay Area today as an innovation center, we talked a little bit about the venture capital side of things. If you look at the production of unicorns, so billion-dollar valued private companies across the country, there's been some media coverage, some companies moved out. Absolutely, they have, no question about it. But when you get to these growth companies, the unicorns, the Bay Area is continuing to vastly overproduce the rest of the country in this kind of company in a way that really scales way beyond what happens in much larger parts of the US, such as New York and Los Angeles, which are much, much bigger areas in the Bay Area. And then if we want to sort of bring it into comparing to places like Austin and other places, again, it's really a very different scale when you look at the production of unicorns. So you can, same kind of story, let's take $5 billion companies. Even more dramatic difference, Bay Area's top line there, much bigger areas geographically, population-wise, New York, LA, Very different story. And Austin, you got to look pretty hard to find one of those. There's a similar graph we could show about $10 billion companies. It becomes even more pronounced in terms of the concentration here in the Bay Area. So these are companies that are relatively new companies, fast growing during the pandemic. Part of the explanation of this lies in AI, where, remember, this only began in 2022, so a really new phenomenon. It's early days. The Bay Area is undoubtedly the global epicenter for this activity. It dominates the country in terms of the concentration of tech related to AI and talent related to AI. So just thinking about what we've seen in the last couple of months. So OpenAI, they just raised another $6.58 billion in capital, latest valuation, $158 billion. Remember, really young company. In San Francisco, we're seeing AI companies really taking the lead in absorbing commercial office space. I think what happened in part was when this whole trend began a few years ago, the word went out through the startup network around the country and around the world that it was happening here. Everybody had to come to San Francisco. And a concentration of these young companies came up into, right around the corner, Hayes Valley. And they called it Cognitive Valley. These are small companies, AI startups that kind of congregated there. They got the attention of venture capital. And as they got the venture investment, they couldn't work out of the homes and apartments around the corner. They needed a real office space. And so we saw them start to go into the city looking for longer term space. So you've got the big companies like OpenAI. Last year, they leased 500,000 square feet in the South of Market area. They just committed to another 350,000 square feet. Anthropic, which is also in downtown, they're going to lease another 230,000 square feet in space that had been occupied by Square. Scale AI in the old Airbnb building is going to take 180,000 square feet. So the most significant, best known, larger AI companies are taking a lot of space. Funny thing about Elon Musk. So even though he's very down in California, he had just announced that his AI company, xAI, is going to be based in San Francisco. And they're going to be occupying the space that OpenAI is vacating to move to their new 800,000 square feet facility. So Jones Lang LaSalle is reporting there were 18 AI leases here in the city in the first 2 quarters. They expect that to triple over the next 5 years. And right now, to the best of our knowledge, there are about 80, maybe more than 80, younger growing AI companies that are currently looking for office space here in the city. And what they're leasing is generally, they're not hundreds of thousands square feet, but they're somewhere between 10 and 60,000 square feet. So this is what's likely, if anything does, to drive the turnaround in office occupancy in downtown San Francisco and all the things that go with that, like street level retail and street level services. So it's not enough to fill the gap. The gap is still huge. But if you ask, where is that growth likely to come from? It's coming and will come from AI. And on top of that, you just look at the region as a whole. The venture funds here, very focused on it. There are large new funds being launched. Salesforce just announced a $1 billion AI fund. Metal Ventures did a $1.3 billion fund last year. Metal Ventures and Anthropic, they're launching their anthology fund, $100 billion. So there's a lot of money. And that money is starting and is drawing US and global technology startups. They may not be AI companies, but they're focused on the impacts of AI, drawing them here in the city, drawing them into the region. And then professional services, business, consulting, banking are following that. So looking at kind of the foundation, we'll measure that. So where are the AI job postings? And you can see the big bubbles up there on the West Coast. That's San Francisco and Silicon Valley. So this is really a question of AI job intensity at a national level. And it it's 4 times the postings compared to the next 13 metro areas in the US. So there's no question about where it's happening. And then, finally getting at kind of the root of all this, kind of the Bay Area is an innovation center, a national and a global innovation center. That's where those big corporate capitalization figures come from. That's where the corporate revenue comes from. A lot of the taxes come from that. That foundation is still incredibly strong. Whatever may be going on at the street level around the recovery from pandemic, street level retail in the city, and other things. So think about semiconductors. 2022, the National Chips and Science Act, really pushing semiconductors nationally. So California continues to lead the nation in company-funded semiconductor R&D. Basically, half of all the corporate semiconductor R&D in the United States is here by Bay Area companies, primarily ones in the Bay Area. The next 5 states together account for 38%. So this is really strong and getting stronger. You can measure by patent generation. The top 5 cities in the US per capita are all Silicon Valley companies. The top 3 companies in the US for patent production after IBM are, guess what? Alphabet, Google, Apple, and Intel. So massive production continuing of intellectual property. And then if we go a little bit deeper, the university infrastructure, which never really slowed down the research and the innovation during the pandemic, it just keeps churning away. Of the top 4 universities in the country that are graduating venture-backed investors or venture-backed startups, 2 of the 4 are Stanford and Berkeley. Stanford ranks first in the country, and Berkeley ranks #1 among public universities. And then we have a continued development of major research facilities and accelerators. Just 2 examples being the huge Baker Bioingenuity Hub near the Berkeley campus, incubating, accelerating lots and lots of really creative biotech companies. And more recently, just about to be under construction, the Baker Climate Ingenuity Hub, doing the same thing very soon. Very large center across from the Berkeley campus, focused on climate technology. So this is an ongoing thing. So what's the bottom line to all this? The recovery here in the region, especially San Francisco City, but in the region, is still slow. Slower than we would like. I think we're seeing that drag continuing in commercial office space and to a degree in transit ridership. Because of course, if not as many people are coming in to work in offices, they're probably not riding public transit. So it raises fiscal issues for public transit. Although for quite a few of the agencies, they're now hitting post-pandemic highs. So people are coming back, but they're also still well below the pre-pandemic ridership levels. So generally, the trend is moving in a positive direction, but only slowly. And I think we'll see that continuing to move slowly in a positive direction in the coming year. There is real competition with other states and cities across the country. There's a good reason why Texas is very much a point of conversation. It's a major destination. If somebody leaves here, the odds are they'll probably be in Texas. And what's behind that? Well, it's the very high housing cost. That's not a new topic, but you saw the rents are actually going up. So high housing costs, perceptions of safety, perhaps the concern's a little bit overblown, but justified. And then perceptions of the business and regulatory environment. That's another reason why companies consider leaving. But the next wave of Bay Area innovation is here. We know how Silicon Valley has reinvented itself for decades. Integrated circuits, semiconductors, computers, social media, cloud computing, broad-based digitalization, and it's really clear now the next qualitative leap is AI. And again, it's being led here from the region with a lot of upsides for the region in Silicon Valley. And finally, again, our competitive base and really the foundations of innovation, which is what drives revenues, it drives incomes here. It attracts global companies and national companies and investment. that innovation activity is very much intact and continues to lead the country. So our sense of it is a lot of issues to be worked out. You only have to walk out the door here and see that they're real. But the trend overall is trending slowly positive with a lot of reason for optimism on the technology and innovation front. Thanks.
Thank you, Sean. And nice to see that we did not disagree. But I think that, you got a really good picture of why we're seeing higher unemployment in California, but it's not so much of a worry. It's kind of a transition we're going through. And we're going to start the next part of our program in just a couple of minutes, but we have to download some PowerPoint slides. So bear with us for about 2 or 3 minutes while that's happening. And then we will move on to our keynote. And it's going to be a really exciting keynote. So we'll start that in just about 2 or 3 minutes.
Okay, we're gonna get started again. So now that we have gone through the forecasting of the US economy and the Bay Area economy, we are gonna dig deeper into the question of AI. I don't know in the back, maybe if you can hear me, but we have started again, and I just want to give an introduction to our keynoter, Cecilia Ziniti, who's the founder, CEO, and general counsel and chief legal officer at her own company, GCAI, which is representative of what Sean was talking about, that San Francisco and the Bay Area is really the capital of AI technology. In fact, I saw recently a presentation by Governor Newsom saying that the 35 top AI companies are based in California, of the 35 top 50. So we're really in the middle of this revolution. And we're very fortunate to have Cecilia with us today. She not only has founded this company, but she's been a general counsel at many of the leading tech companies, including Replit, Amazon Alexa, which was kind of a very early AI, let's say, or interactive device, and Cruise, which is in the electric vehicle side. Before that, and because we're in the law school, she was a litigator and commercial lawyer at Morrison Foerster. And so I always like to see lawyers go into business and be entrepreneurs. And I tell students, you can go practice law, but you can also start companies. And it always gives me a lot of pleasure to have people like Cecilia with us today. So thank you very much. And we look forward to your presentation.
Thank you, Evan. Hi, everyone. I'm Cecilia Zaniti, and I'm the founder and CEO of GCAI, which is AI for in-house counsel. And Evan asked me to speak. I had been here at UCSF a few times, proud UC Berkeley alum, go Bears. And when I thought about, okay, let's present on the future of AI, I thought, you know what? No, it's the present of AI. We have almost 2,000 users using AI every day. We just hit 350,000 chats, which if you do the math at big law rates of $2,500 an hour, that's real, that's tangible. So let's get into it. All right, we're gonna do a pop quiz. The Slido isn't working, but we'll just do show of hands. All right, my mother and grandmother were both teachers, so I'm weirdly nerdy about pedagogy. How many of you are using Gen AI for work? All right, who has never used generative AI, so ChatGPT, Google, any of these for work? Never. You got a never? Okay, all right, that's all right. It's good, it's cool. It's good, safe space. All right, how about weekly? Who maybe weekly logs in and counting, I'll ask a question or two. All right, that's a good group. I love it. Daily? Anybody at daily? Ooh, good. All right, who's at hourly? All right, nice job. You are the early adopter. Way to go. I love to hear it. Congrats. So for those of you watching on the live stream, we had a couple of nevers, but really weighted to people that are using it every day. And we can talk about what is the future and, the internet and all these things. But what I want to carry home is like the future is now and it's coming fast. And so for all of you, if your thing is like corporate governance and boards and how do you lead your businesses to take advantage of this, that's going to be my central message. If you take away one thing from this talk, it's go home and get to it. All right. It's already here, this future. So let's take a look. Crossing the Chasm. Anybody recognize the great business book from which this comes? Yes. Amazing. So it is Clayton Christensen wrote Crossing the Chasm, and it's basically about how tech is adopted, right? So it goes all the way back to literally like the camera, the locomotive, all these things, a lot of the IBM technologies. And the core idea is basically that at the little red box at the beginning, the little red part, that's our guy in the back using OpenAI every single day, right? Then we had a pretty decent group of folks all the way up through the green. So this is a room of early adopters, right? You're people that come to conferences, people that care about the future. So I would put you in this yellow or green, or possibly the sort of aqua there. But the core idea is that AI has already jumped that chasm. We are there. This is not like a theoretical debate anymore. Let me tell you some stats. So ChatGPT has over 100 million users. That means that over 1/3 of the population of the United States, in terms of size, is using it. In different demographics, if you look at high schoolers, that number shoots way up in terms of percentages. The time it took to reach 1 million users on ChatGPT, 5 days. Okay, so on this chart, you're seeing, Meta and Facebook, which today, literally 4 in 5 humans on Earth use Facebook every day. So it still took Facebook more than a year to hit a milestone that ChatGPT hit in 5 days. So when I say something like this as a technologist, what's occurring to me there is like, this technology is really good. It's something that we did not have before that we now have. And the pull is so strong that even with a weird name like ChatGPT, you can barely even say it. It catches on with this virality because the possibility of having an idea in your head, having an AI do the typing, doing that expression of the idea, that's what's new. All right, some more stats. OpenAI, we saw the prior speaker mention this, is worth $156 billion, the biggest venture raise in history. They raised, I think it was 10 billion at that valuation from a really nice group of VCs. Businesses adopting AI, this is per PwC, have seen an average revenue increase of 6 to 10%. So, it doesn't take a room of economists, which this is, to realize that is huge, right? So technology standpoint, when you're doing business process consulting, improvements of 1% are enough to get people really excited. That's considered a success. When you take a 6% base on $1 trillion company like Amazon, you've got Andy Jassy out talking about how they use generative AI to upgrade parts of their code base, and they save 1,600 person years. Okay, so you think about that and you're like, this is no longer a debate. This is real. This is what businesses are doing. This is what attorneys are doing. This is what any kind of knowledge worker is using AI for. 1/3 of professionals surveyed by McKinsey say they're using Gen AI regularly in at least one business function, with nearly 1/4 of C-suite executives personally using Gen AI tools for work. So congrats, this room is doing better than the C-suite execs polled by McKinsey, with about half of us using AI at least weekly. But that's the stat. And so again, call to action here. And then 45% of public company earnings calls this quarter mentioned AI. So, very similar to .com back in the day, but with the idea that you can use AI across industries, right? So we have a customer base that includes literally, Mode Global, which is a transportation and logistics company. We've got them, their legal team is in there using the product every day. We've got, companies like, veterinary supply companies. And you don't think, oh, okay, what's an industry that uses AI? How about veterinary supply? Well, guess what? They're using it every day to do their knowledge work because increasingly obviously the logistics and the operations we can squeeze out of logistics have gotten, smaller. Those percentage increases of some effort that could increase your production 6%, it's very difficult. But with this new technology, that's where we are on the knowledge side. All right, startups. This is near and dear to my heart for obvious reasons. So Stripe, also headquartered here in the city, founded by two Irish guys who are amazing and said they could never have done what they did in Ireland. But in any event, Stripe is a payments company and it allows you to take payments on your website. And they found that companies that selected AI as their company type took only 11 months to hit $1 million in revenue after their first sales versus 15 months for even just SaaS, which is already a previously hot space. The graph on the bottom with the obscured y-axis, don't kill me, I learned that at Amazon. We never put X's on any of our graphs. But in any event, that is my company's revenue. And, I don't want to say it was a little effort because it was a lot of effort, but essentially went, approach numbers that this slide is talking about in that amount of time with a very perfect hockey stick graph. So this is the idea that by offering a service that people can use to be more productive, right? The like picks and shovels, you can actually, have a really, really nice business. All right. So 3 implications for you all right, that I want you to take about AI being real now. Knowledge work changes. It really does. It's like overnight, all your workers from the most junior to the most senior, they all got promotions because they now have somebody to direct, which is the AI. The practice of law, near and dear to my heart in this building, it changes. What's a job where you have a lot of tedious words? Guess what? Law, right? So everything from due diligence, where you're looking at reams and reams of paper around what are the contracts that we're assuming, what does this business look like, through litigation, right? So a girlfriend of mine is a plaintiff's side employment attorney. She's a UCSF law alum, actually, now that I think about it. But anyway, she's a plaintiff's side employment attorney. She had a case with 7,000 pages of text messages between the parties, and essentially used AI to find the juicy bits, right? And in employment law, it was not good, but let me put it that way. But anyway, she had a very nice settlement from there. But that is something that previously, we've all been there. Those of us who are attorneys, where we've all had that project where it was like you're next, with the like Web 1.0 relativity software, and you're like, okay, you find the good one, the smoking gun, whatever. But with AI, you can home in on that. In a very similar way. Does anybody remember the first time they used Google? You remember that? Okay. For me, it was the year 2000, and I was studying abroad in London. And I was working for actually a little tech company there, a little tech consultancy. And my boss at the time said, hey, Cecilia, have you used Google as a search engine? And I remember thinking at the time, I'm like, yeah, I use Alta Vista, like what, okay, fine, whatever it is. And so I'm like, all right, let me try this if it's supposedly this much better. So what do? I Google my name because vanity, right? And what do I get? I get high school tennis scores from years prior. So it's the year 2000, I get 1995 tennis scores saying that I had, lost 6-4 or whatever, still bitter about it, to Edwardsville, Illinois. And I was like, how in the heck did it find this published in the Panther Gazette in whatever it was, right? And it was really this moment where I very, very distinctly remember a before after. All right, how about the iPhone? You remember the first time they played with an iPhone? Yeah, that's a much bigger group. So same thing. Now we all carry, 4-inch squares of glass in our pocket, and we don't think about it even as tech. But if you think about the aspects of your life that this has affected, from everything from ordering groceries this morning to taking my Uber over here, to connecting with loved ones, to WhatsApping friends, to literally everything you can do on a phone plus internet today. Imagine now you have an agent, you have an AI helping you to interact in those ways. So you can take a really, truly maximalist view of AI and apply it to effectively everything: medicine, economics, law, whatever it is. But the way you get there is through these concrete steps, which takes me to the next point. So my encouragement for you all, I think this group is already advanced. We established that from the poll, the show of hands, but is to literally like push yourself, because the more that you the less you debate and the more you do, that's where the innovation lies. And, Elon Musk with the amazing achievement this week of catching the rocket, so inspired. You can think what you want about his politics, but it is truly an extraordinary achievement. He gives the advice that effectively, like, get out of your head and onto the page or onto the paper, into the real world like you are. All right, so knowledge work changes. I have a video here. I'm very hopeful I can show it. I don't know if I can. Let's see. I don't know. Let's see. Let's go. Amazing. All right. All right, we need sound. Let's see. Love that we have a video. Try it one more time. No. Yeah, exactly. All right, so you know what? I'll explain it, but go ahead and pause it on his face so we can, or unpause it, or so we can see his face. And go back to the deck. So this is Darren, and Darren is our founding engineer, and he is absolutely brilliant. 2 poetry degrees, learned to code on the side, worked for Toby Lutke at Shopify directly. Brilliant engineer. And he uses a software called Cursor. Okay, so Cursor is generative AI, think ChatGPT plus where you code, put them together, and the GPT or the Claude or whichever LLM you are calling provides suggestions for code, writes whole sections of code, modifies files, etc. And man, I wish I could get his voice. But anyways, he was at a barbecue with a fellow engineer. And he says, hey, are you using Cursor? And the guy says, no, I'm not. And he says, well, look, here's what it comes down to. Olden days, when I had an idea for software, I had to spend a week writing the basics, the core files, the setup of the app, etc. Now that is 10 minutes, and I am a better dad. I am happier. I am more creative. The BS part is done for me. So imagine if you have a technology where the BS part is done, you get to do the fun stuff, the creativity. That's why you get these startups hitting $1 million in revenue in 2 months, because they enable that for others, right? And the idea that the cost of creation has just shot way down, right? So we used to talk about the creator economy, and that's obviously a thing here too. And YouTube can make anyone a star. Kids want to be YouTubers. But it's not just having the platform to distribute. This is the platform and ability to create. So essentially, we've been able to accelerate our roadmap tremendously. And he thinks he convinced this guy, where this person said, oh, AI, I don't trust it. But the amount of time and brain energy that you save, if you think about, when the steam engine came out, they had a hard time marketing it of what it really was, because people were used to horses, until the guy, I forget his name, but anyways, the inventor of the steam engine came up with the concept of horsepower. It was like, so we still use that today, right? Your car has, 60 horsepower, whatever. Same thing for AI. This is brain power on a spigot. And he's saying, I get to use my brain power on making the app and not on setting up the file system, on QA, whatever it is. So software is one of the professions that has caught attention the most, because it's a very skilled user. But what else is a very skilled user with very technical language? Being a lawyer, right? I literally, when LLMs came out, immediately caught my attention. I started to use it tremendously, to the point where I quite literally quit my job as a general counsel on November 1st of last year, incorporated GCI on November 8th. Because it was very clear to me that as lawyers, me and my fellow folks we're large language models. I used a software called Grammarly, which was an AI grammar checker, highly recommend. And it told me that I wrote 19 million words in 3 years. A very normal lawyer job. Do the math, that's 70,000 words a week. which is effectively a small novel every week. So I would wager that all of you in this room have a very high average word count. So again, AI is going to be, or LLMs in particular, generative AI, the technology underlying generative AI is going to be a very good fit for you. So, you can learn something instantly. Let me show you something really quick. I'll do a little demo here. This is the product. And I think you can click it if you can. I don't know how to do that. Are you able to click that? Shoot, okay. I have to take my word for it. But anyway, the core idea is that you can ask a question. Let's see, can we get it? I wonder if we can. Are you able to animate it? Yeah. Click on that. All right, so hit play on that and it doesn't have any volume, so it should be fine. So this is me searching for a prompt. Teach me a concept in 3 levels of sophistication. Revlon duties. Okay, this is a corporate governance conference. Revlon duties are the duty that a board director has to get the best price in a sale. So it's going to go out, it's going to do the research, and it's going to come back with 3 levels of depth of explanation of what Revlon duties are. So give it a minute. It's searching. Sure, let's dive in. For a senior partner, Revlon duties arise from the landmark case Revlon versus McAndrews from 1983 in the Delaware Chancery Court. The doctrine establishes that when a company is for sale, the director's fiduciary duty shifts from preserving corporate independence to maximizing shareholder value. Beautiful explanation. Took less than, 30 seconds? And look at the next bullet. Hey, in-house counsel, you probably don't want that garbage with all the citations. Let me just give it to you straight. Same explanation, but in that language. And then look at that third item. If we could actually pause it on the very last bit. Yeah, so push pause there. Yeah, push pause, exactly. Think of Revlon duties as duties that kick in when a company is being sold. The people running the company have to switch gears from their usual job of long-term board planning to make sure they get the best price for the owners, the shareholders. So I just gave you 3 expressions of the same idea instantly, right? So think about the amount of times you've had to translate between colleagues. Maybe when we are with your finance folks, you're talking about EBITDA, et cetera. Maybe then you turn around and talk to your sales team and you're much more motivated about whales and bluebirds and all these sales terms. And that idea that the expression of language, not merely the distribution, but the expression of it, everyone has a tool to instantly express things how they want. It's literally, that's why we're here. That's why this is real today and why products like this are so sticky, right? So in our usage, we get people, we had a user last week, 258 chats in a week. So that means she's doing 50 a day. So we're not talking just hourly, we're talking every 5 minutes she's asking something or getting help or expressing her ideas in this way. So again, I would encourage you to take away from this talk, like, yes, I hope that you find my pretty graphs pretty, but what I really want is you to go back and use it and do it and investigate and do more. All right, so next slide. Okay, so you can learn instantly. So what does this mean for lawyers every day on the ground? So basically, excuse the slight marketing slide, but it is actually a profound concept. So many efficiencies, game changer, time saved, hands down the best tool I've ever used. Easily one of the best investments I've ever made for my law practice. My team today had a meeting where we talked about our best prompts, and our favorite prompt is use a 6th grade reading level because this is for sales. Superpowers, integral, best tool, board meeting prep, sections of a press release, settlement negotiations, operations update, budget review. Correct every time. The idea is, better responses, et cetera, tuned, accurate, whatever. I mean, the point is like, that promised land is not tomorrow. It's not, oh my God, what will happen in a few years. It's enough that Chief Justice Roberts, do y'all know this? So Chief Justice of the Supreme Court, John Roberts, wrote a report on the state of the federal judiciary he does every year. In December of 23, he came out and said, look, when AI will increase access to justice tremendously. So in California, as an example, 50% of divorces are completely unrepresented. Of the 50% that do have representation, 25% of those, only one party is represented. So you think about, okay, divorce maybe should be uncomplicated, but even still, if you think about one spouse being represented and the other not, is that justice? I don't think so. So how can you have AI create a threshold access to justice? That's something that I know here at UCSF Law, they're working on really hard. I think UCLA has certainly an AI initiative as well, but that access to justice piece is huge. And then on the corporate side, all right, you're going to use AI, so am I. Guess what? We're in litigation. It's an adversarial system. Very similar with deal work as well. So the negotiation, the amount of negotiation, the amount of precision, the amount of things you can launch. By the way, regulators for this crew are also very interested. So SEC Chair Gensler has come out and said that, guess what, public companies, you have AI now. Don't mess up your filings. That's a threat, wink, wink. So if you can use AI to be perfect, is there an excuse for typos in your SEC filings? Is there an excuse for not catching things? Is there an excuse for not disclosing something? Not really, especially when you can do it more cheaply and more thoroughly using AI. All right, so great generative AI use cases. If you need a spark of inspiration for when you get back to your desk, essentially distilling things. So again, I distilled Revlon duties for you all in about, I think it was 25 seconds. You all probably very good and very capable, but I guarantee it would take you longer. So reviewing, AI is really good at this. You have a checklist and you run it against that checklist and get your results and go about your day. Drafting. Okay, so if I were to tell you, I want you to come up with 25 interview questions for this panel, go. What is the fastest that you could come up with? Maybe half of 25 minutes, 12 minutes? We can go and do this right now and basically get it immediately. So that idea that this like fresh draft, can you have an intern go and draft for you? That's AI. Researching, this one is like, I think where it gets interesting here. So this was a super fascinating one, again, in a marriage law example. I got asked to speak at the American Academy of Marriage Lawyers, been happily married for 20 plus years, and there's scarce a legal topic about which I know less. But in any event, they're like, hey, you're an AI person, come talk about AI. Cool. So I speak about AI, and in the process of doing that, there were, this was the California chapter of that organization, and they had folks from Southern California and folks from Northern California. And in the process of prepping for this AI talk that I was giving, I spoke with a bunch of very experienced marriage and family lawyers. And I said to them, I said, okay, what are the soft factors? What are the things that, you think AI probably couldn't do? And super thoughtful answer from the guy who was the chair of this org. He's done like, I don't know, 400 divorces or something in his career. And he said that in Southern California, in marriage law, you sue first, you call later. That is how they do it. Northern California, on the other hand, we have stock options, as we discussed, right? Startups, more collaborative. We don't like phone calls. We're maybe a little friendlier. Much more likely to engage in settlement negotiations and discussion first. So you can actually see this in the timing of the cases. The average case in NorCal is shorter for that reason and more likely to go to mediation. Now that is something that an AI could read hundreds of pages of law, lots of rulings, and not know that. So you think, okay, what is the value add? What does it mean to be an attorney? Is it judgment? Is it experience? Is it living in the real world? Is it taking a phone call from somebody trying to decide, am I going to sue or am I going to do a settlement or are we going to do mediation? Somebody, by the way, who's at a very emotionally sensitive time in their life, right? So other funny anecdote on that, on AI and law, I asked the guy, I said, okay, what else? How does a typical marriage case go? Do you use referrals? Do people find you on the internet, whatever? And he said, okay, almost always it's a phone call. And he's like, the most frequent thing said by somebody calling to see if they want to hire me is, Joseph, do you have experience dealing with narcissists? That is question one every time. He's like, it's about 50%. And he's like, I have a timer on it where it's like about 2 minutes in, that's when they ask. And something like that, that level of experience, that level of knowledge and depth on the situation, the very human situation, mind you, to be solved by the lawyer, that's something that AI is not there yet. So use AI for what it's good at, right? The research, has a court ever granted, child custody in XYZ situation? AI can be great at that, looking at existing knowledge and giving you a review of what that says. It will be great. But that judgment of like, oh my gosh, we're 87 seconds in, they're going to ask about narcissism. AI is not there yet. It will get there. AI today is very similar to very early internet, right? Anybody ever create Shutterfly photo books? Am I the only one? Okay, I see like 2 people's hands went up. Okay, remember when we first started doing that? Shutterfly is an online photo service and you can create Christmas cards or albums or whatever. I started making them for my first kid, who is now 17. Got really into it. And it would crash maybe about like half the time. Like you try to move the pictures and whatever and add like a little bit of a caption and then suddenly crash. Now you tell Shutterfly, you're like, make my book button. You put it and then the book is on your physical doorstep 2 days later. It's beautiful. It's thematic. It has like, borders that are associated with whatever it is. So that's where AI is today, right? It's like crashes some of the time. It doesn't understand you. It's not quite powerful enough, but it will get there. And so the more you use it, the more you understand how it works, the more you apply it to your respective businesses, kind of the better results that you'll see. All right, try it yourself, of course. You can try my app. I have a trial. You Google GCAI or you find me on LinkedIn, I'll send it to you. Or you just try a free ChatGPT account. But those of you in finance, there's a bunch of different options on the finance side. There's a startup called Equals out of San Francisco that's basically AI for Excel. There's a startup called Fathom, which does absolutely insane meeting summaries. If you are a lawyer and you're like, I want to be recorded, you know what? Guess what? You're recorded every day, all day. Like pretty much, there's not, if you've ever posted on Craigslist, posted on Instagram, posted on any of these places, you've trained an AI. I'm sorry to tell you. Posted on LinkedIn, by the way. LinkedIn now did announce that they are training on everything in the United States. So there is a setting, if you go to LinkedIn settings, turn off training on my data. All right. Teams that use AI, shocker, are better at AI. Again, I kind of use the bike metaphor, which is basically, if you're thinking about riding a bike, you have a lot of options, right? You can go to Schwinn.com, you can watch YouTube videos, you can go to CLEs, you can, assign somebody on your team to go look at bikes, or you can like get a bike and learn to ride it, right? So I just recently, my 4-year-old now is riding a bike and it took a lot of, butt on the bike and kind of like, I'm wobbling, whatever. Point is, like, this is like, get out there and practice. In terms of how it works, I guess I would say there are some folks in some professions who are very, very good with words, right? So 27-year litigators, like my friend, the marriage lawyer. But I say giving them AI is like giving a trained marathon runner a bicycle, right? Where, you're like, I got to do the straps and like, the helmet and like, but like, you're ultimately quite a bit faster if you have a bike, and especially if you have a purpose-built bike, right? So this is like my thing, that my tool is like dedicated for lawyers or Equals for accounting or, Grammarly for grammar, is like you want the right tool for the job. But ultimately, if you want to go further, faster, and by the way, if you're an elite athlete, like an elite marathon runner, you're probably a pretty good, better biker than the average person too. So challenge yourself, see how far you can go. All right. That's it. I do have time for questions. I could talk about AI all day, every day. So let's do it. And I think I totally just actually messed up the slides. But anyways, if you could help me figure out how to go back to the right spot. Yeah. Okay, cool.
Can you hear me now?
I can.
Did you use AI to make this presentation?
I did. I said, give me 10 interesting stats on AI. And that's where I got the McKinsey report and the PwC one. I had seen them before, but that is a perfect distillation task. Now, the presentation itself, I personally have not found great software to actually lay out slides. There's a startup called Beautiful that gets a lot of play in this area. I'm a wee bit anal about slides, so I do not use them, but I want to. So like AI-ifying myself is something that literally I encourage myself and my team to do. The meeting summaries, there's an influencer called Allie Miller, Allie Miller, and she is all about kind of AI-ifying yourself with general tools. If you're just getting started, I highly recommend her.
One more question.
You do both of us.
Just a question around with the proliferation of all these startups, I would imagine the cost of compute's going to continue to be very high. So as a founder of a startup, like, how are you managing some of those costs, or is that not part of your business model?
Yeah, I mean, we're making money already, so we're able to pay them. And for us, the compute kind of scales with use, where, you know, our OpenAI bill, I know because I get alerts on my phone from Mercury when it hits every $1,000. But we're a premium product, so we charge more and we're able to do it. I have seen a lot of creative things come out. Like I had a VC pitch me recently that were like, we're equity for compute. We bought a whole bunch of, you know, H200s and you know, you're just going to get access to all that compute that we are stockpiling for you. So you do see some of that stockpiling behavior and people are definitely asking the question, but for us at the application layer, it hasn't been an issue. Amazing. This was so much fun. Thank you for having me.
Okay. Now the fun part, corporate governance part. I know you're all waiting for that. So we're gonna invite the panelists to come to the panel. Just yeah, just come in and we'll sit down and we'll try to make it the most out of the incredible content that we have. You all have this booklet in front of you, so I'm not gonna do a huge introduction of each of our speakers, but we've assembled a very specific panel with different expertise. And the idea is to talk about governance in AI and how that's evolving from different viewpoints. So to my left, Mark Bodler is a partner at Wilson Sonsini, the leading law firm here in the Bay Area, advising a lot of the AI companies. Patrick Ikaruo is the Deputy General Counsel at Anthropic, one of the leading AI companies. And if you haven't heard of it, you don't know much about AI, or you kind of missed what's going on. And Yvonne Wassenaar is a very well-known CEO and board member of many companies. So we have three different viewpoints from a practitioner, from a person who is actually in a company leading the AI wave, and a board member. And so I think that's how we balance out this session. And the first question is going to go out for Patrick for a very specific reason. One thing that is happening in some of the leading companies is that the companies themselves are using different corporate structures. So typically, a startup will be a C Corp, and they will have shareholders and a board, and they'll raise money. And that's been the tradition for 60 years. In this case, well, you all probably have followed what's going on with OpenAI, which is a nonprofit corporation. That's its own set of issues right there. But Anthropic and many other companies are a public benefit corporation. And I'm going to ask Patrick, why is it a public benefit corporation as opposed to a traditional C corporation? By the way, OpenAI is talking about converting from a nonprofit to a public benefit corporations. xAI, which is Elon Musk's company, is also a public benefit corporation based in Nevada, not in Delaware. Inflection AI was another company, also a public benefit corporation that got acquired by Microsoft. Not really, right? It's one of these reverse acqui-hires, synthetic acquisitions, as they say. And the specific thing that Anthropic did, which is very, very unique, is they did a long-term benefit trust to elect members of the board through this public benefit corporation. So it's got two really interesting layers. Now, in every prior era, we've never seen companies really innovating at that level of governance. So my first question is, why a public benefit corporation? And what's the long-term benefit trust? And if you can explain that, maybe that's going to be the first question to explain how the industry is thinking about these issues.
So first, thank you for inviting us to talk on the topic. Second, to your question, why is Anthropic a public benefit corporation? I think there's two specific reasons in law that lead to this like determination, and then there's like the broader kind of industry specific rationale. The two legal reasons are, one, specifically a public benefit corporation gets to include in its charter a purpose that is outside of what a normal Delaware C corp would include, which is like the broader benefit. So the broadest conceptualization of a C corp is you maximize shareholder value. With the inclusion of a benefit in the charter, the company has a twofold obligation or twofold responsibility. One, yes, maximize shareholder value, but you also get to balance this other interest, whatever your benefit is. Anthropic's being the responsible development of AI for the long-term benefit of humanity. Pretty mild stuff. The second legal reason is for your directors. It broadens their fiduciary obligations to allow them to consider more than just, again, maximizing shareholder value. They again get to consider in all of their decision making non-pecuniary interests, which allows a broad, which allows a lot of leeway when their determinations are being examined by any Delaware court. So flexibility is ultimately the answer. So why is that flexibility important? I think so. The flexibility is important because unlike a lot of different industries, or at least the perception, and this is a question for, there are people on either side of this issue, but our founders took the perspective that there are material risks that could arise because of the technology, and unless they're taken seriously, and unless you create a governance framework that would kind of challenge traditional like corporate norms, the traditional like kind of leverage shareholders have, or the traditional kind of default to shareholder judgment, there might be broader societal consequences that none of the founders or I guess leaders in the industry want to materialize.
And so I don't want to downplay that, because that's a huge development of companies that are literally the leading companies changing the industry. And can you add a word about the long-term benefit trust? Because that's really a key innovation that is, even when it came out, Anthropic said, look, this is an experiment, and maybe you can talk about that.
Yeah, so it is an experiment, but the idea is like with all, you're trying to create a framework that reflects the balance of interests. So the shareholders are still going to be an important party in whatever determination the company makes. The founders are still going to be an important party, but how do you create the incentives so that who's going to be the stakeholder who represents the long-term benefit of humanity? Who's going to actually, and then, so that's question one. And then how do they get to exercise that authority? We elected to create a party, an institution that is outside the typical framework. And give that, give that institution the mandate to keep us honest when it comes to like determining what the long-term benefit of humanity is, because that in itself is a big question that maybe people within the company may not be in the best position or may be conflicted in trying to answer. And then, you know, have them be our oversight. So to the extent that we are not fulfilling what they believe that mandate should be, they have the ability to replace directors. This is definitely an extreme position that most companies don't take, and but we think it's mandated by the fact that there is no regulatory framework, right? There is no U.S. AI Act, so we have created that regulatory institution ourselves to make sure that we continue as we grow to kind of be true to those founding principles.
So we had a call to kind of prepare this panel, and it was my understanding that, well, first of all, there's a power law in Silicon Valley, and I'm sure a lot of you understand the power law in that it's the few companies that make the returns for everybody else. And there was a report that said that there were only 4 of the top 100 AI companies that were doing these charters, social, structures. And Mark said, well, there's more than 4. And so maybe there is a trend here that maybe you should talk about as a partner leading a lot of the advice to AI companies. How broad are you doing these different charters or other changes in corporate governance that are specifically for AI, and why maybe beyond Anthropic, and what do you see as trends there?
Yeah, no. Well, first of all, thanks for having me, and thanks for having us. We're having variations of this conversation daily at our law firm and with our clients and with industry participants. So this conversation is very topical. We actually helped Anthropic with the structuring of their corporate governance. One of the interesting aspects to me, both of Anthropic and OpenAI, is that they are dealing with these issues not as a nascent public company. They're dealing with it as large, more mature private companies in the public eye. We also represented Inflection when they were incorporated. That was a little bit of a different story because they had yet to receive any money, and the founder, together with their lead investor, were very focused on these issues. They did elect to set themselves up as a public benefit corporation, and I'll come back to that in a moment. We have a number of companies in the AI space and some outside of the AI space that grapple with these issues. And I think that when you're talking about what I refer to as bespoke corporate governance, meaning that you're not having a knee-jerk reaction to setting up a Delaware C Corp, I think it starts with, what is the mission of the company, what makes it different than many other technology companies that calls for a different structure? Is there really these other interests that Patrick described that are so compelling that you bake that into your charter as other considerations for the board to take seriously and to have fiduciary duties with respect to? When you're a public benefit corporation, yearly you're putting out a report on how you are progressing against those articulated goals or purposes of a company. So you have to take this, seriously. And we take a lot of care in crafting what the public benefit corporation is. But I do think it starts with what makes an AI company or a particular company different than a standard C Corp. And so we have a number of AI companies that have come to us, and in part because of the publicity surrounding the governance issues from companies like OpenAI and Anthropic and others. They're asking these questions. Oftentimes, an AI can be used in different ways. Some people are using AI as kind of the core technology of the company, and they're advancing AI. Some people are incorporating AI into what the company is doing separately. So I want to separate out the two of them. But where AI is core, there's often considerations that are not dissimilar from the ones that Patrick described, and kind of putting, some guardrails around that and what the company's mission is. We spend a lot of time with that. When we do a C corp, what I call a knee-jerk C corp, there's often not a whole lot of work that is involved in it. In fact, the automation tools make it pretty easy to incorporate those companies very, very quickly. When we're having the conversations that Patrick is describing, these are conversations over several days, multiple phone calls, multiple meetings sometimes, and getting together and really doing this on a very bespoke basis. So you have to do it with intentionality. And, it's not just the top 4 companies that are doing this. I would say roughly half of the AI companies that I've incorporated in the last 2 years are public benefit corporations. None of them have the benefit, the public benefit trust aspect that Patrick was describing, but they all also grapple with, board control. Is it the founders that control the board? How do they want to set this up? There's issues in terms of fundraising, in terms of the signaling that founders need to take into consideration. Suffice it to say, not every founder, has the stature of, let's say, Mustafa Suleyman, who can kind of dictate, and he's the founder of Inflection, in terms of what he wants, and have investors go along with it. And so there's a balance in that direction as well. But those are the conversations that we're having with these companies when they come to us and they say, hey, we've heard about these bespoke governance structures that other companies have put in place. Is it right for us? And I do think it's worth pausing on that, because it's not necessarily right for everyone either.
Wow. Half of all the AI companies in the last 2 years are PBCs. That's a huge trend, and I want to stay on that. But Yvonne, I want to go to you. You are our director here. And so for current directors, probably the number one topic in the boardroom today is AI, right? There's always been cybersecurity. There's always been other issues, but AI is today probably the leading topic. Give us a sense of, how do you think about it from a boardroom perspective as a director, but also how boards are facing, not only from the disruption side, but as a board member? And maybe you can give us a sense of what is the discussion in the boardroom about AI.
Yeah. Well, thank you for having me. And it's a great conversation. The first thing to know is not every company is an AI company, but every company does use AI. And I think that has an impact on how you think about it and what you do. I sit on a pretty broad portfolio of boards, everything from late stage private to private equity to publicly traded, both on the NASDAQ and the New York Stock Exchange. And the first thing that I think is really important to grapple with from a board perspective is, what is the profile of the company that you are governing and have a fiduciary responsibility to? Because it's very, very different if you're a small startup with limited reach and not much to lose, versus you are a very large Fortune 100 company working in a highly regulated space. Just your whole perspective on what to do around AI and how quickly and with what guardrails is very, very different. So the first thing you need to do is recognize that. From a board perspective, in all situations, there's really 2 types of conversations that we have. The first is on the strategy side. So how are we leveraging AI? How is AI going to help us capture more business opportunity? And what I would say is, without proper framing, a lot of people become very tactical. And so they think about how AI is going to make the current widget better. And an example that I thought was great, I was part of a research group, I want to say maybe 10 years ago now, and we did a bunch of focus groups on autonomous trucking. And it was fascinating to hear some of these truckers talk about how they thought it was going to be amazing that they could sleep while the truck was driving. Like, it never occurred to them, like, they may not be needed in the truck if the truck could drive itself. And it's really important that companies think about how is AI going to make what we currently do better? So if you're a law firm and if you can make your, your junior clerks more effective, if you can prepare better briefs, if you can do all those things, that's all great. If you're a software developer and you're using a co-pilot to develop software better, faster, cheaper, awesome. Do I really need developers anymore? When does the software start writing itself? And I guarantee you it will. It's a little bit like for those of you who are old enough to remember the Flip. The Flip took movies. It was great. It was wonderful. Cisco bought it and all of a sudden the iPhone came out and your phone could take the movies. You didn't need the Flip. And so it's really important from a board perspective that you're pushing the company to think about practically, tactically, how can you drive greater efficiency, productivity, higher customer sat, all of those things today? And what is going to be the big disruption in our industry? What is fundamentally going to shift, change? And are we going to be the ones to do that? Are we going to acquire the ones who are doing that? Are we going to be disrupted by that? What do we do? So that's the first half of the dialogue. The second half is risk mitigation. How do you ensure that whatever you're doing, is in alignment with governance requirements, is safe, is, taking respect of GDPR, like all of these different things. It doesn't have bias in it. And so it's really important that you look at both sides of those equations. And I think one of the things that's kind of been percolating a lot is, whose responsibility is this on the board? And what we've started to recognize is, to a certain extent, you need to look at the outside factors, and some governments are doing more around AI regulation than others. But we would say in general, none are really moving efficiently or effectively fast enough to be sufficient. And so then you have to turn within the industry and within your own structures to try to do your best. And it gets segmented out across what is the responsibility of the audit committee, which generally does a lot of the risk mitigation, a lot of the data and the technology and so forth. What is the responsibility of the board itself? Do you have enough expertise on the board? Do you need a separate committee or council or set of advisors to come in? And most recently, what we've started to realize in several places is, where does this fall potentially in what historically was called the compensation committee, but really around the human assets? Are we going to be fundamentally restructuring how jobs get done and having massive implication to our workforce? And what are the strategic, tactical, and P&L implications of that? And are there unions involved? And are there regulatory requirements? Is there reskilling, retooling? So there is a whole host of issues that I think the further down the path we get, and I would agree we're very nascent, that are starting to bubble up. And it really requires us to continually be tapping into others to really learn as a community, and then try to really think in a fast and nimble way what's most important to both deliver on expectations today, but set the institutions up for success long term.
Yeah, no, that's really interesting, and it is starting a nascent industry, and people say that this is a paradigm shift like never before. I do want to tell the public that ask any questions. I really like interactive sessions. So if you want to grab the microphone and ask questions as we go, please do, because I think it makes it more fun to have an interactive session and hear from you. Patrick, there's been a lot of discussion around AI and data privacy and IP issues. There are litigation that is ongoing. How do you think about the issues on data privacy, IP? How do you think it's going to go as more data gets consumed by Anthropic and OpenAI and all these companies that are using it to generate, chatbots and others? What is the current thinking and guidance that you have for these issues, and where do you think we're going with this?
So I'll qualify my response by saying I'm a corporate lawyer, so IP is something I touch on, but it's not my core competency. That said,
You could ask a chatbot.
I could. It'd probably get you an 80% better answer. We're not there yet, though. Yeah. But I think there are three areas with respect to data and data privacy that are still playing out. The first and the biggest that will have the broadest implications on the economic model for LLMs is the ongoing litigation around fair use. All these LLMs require a lot of data. As much data as you can imagine, these models can consume and need to consume in order to continue to get better. There's a question around whether all the information that these models consume is done under fair use, or whether it infringes on the rights of those IP holders who may not have consented to their data being used. This is a open question. I think that there are a lot of, the industry would say that the fair use argument is strong. This will probably be litigated at the Supreme Court at some point, and the determination there will lead to reallocation of economic rights throughout the industry, which impact and the outcome's unknown. So that's the first biggest question. The second question is contractual between AI companies and their customers, which is if I'm a customer of yours and I get sued because you breached somebody else's data rights, whose obligation is that? And there's a risk shifting that can happen contractually. I think most customers are saying, look, I'm just trying to create the widget here. Like, I don't know anything about AI. You're the AI company. You bear the risk. That's like the cost of doing business for you. I think that's largely where, for like the LLMs, for OpenAI and us, that's where the status quo is. Whether that's going to exist between AI service providers on like a vertical level, I think that's still up in the air. And then the third piece is just as companies, what is your stance both with respect to training off your customer data and like allowing others to train off your data? I think data is going to become, to some degree, a moat in the industry, right? Like you see right now, if you have specific data and you train it on top of a model, your model becomes infinitely better at that task than Anthropic's model, OpenAI's model, right? So if you're able to ring fence data for your specific purpose, you can actually deliver a powerful product that could be somewhat protected. I say could be because there's also budding legislation around allowing customers to move their data. So that moat may only exist for a short period of time. But if you're able to like hold on to your customers in a different way, like that data and your ability to, train a particularized model on that data becomes really interesting.
And that takes us to the open versus closed discussion and debate. But Jerry, I see you have a question in the back. It's going to have a green button.
Now it's on, right?
Yes.
Yeah, so first, thank you to the panel. This is really great information. There's currently a shortage of accountants, including auditors. And so my question is a governance question. Accounting is obviously a cognitive activity. So with the shortage, you can expect a lot more use of AI, both in the accounting department and by the auditors. Does this create kind of exponentially more difficulties for a CEO or for the board in governance? Do they have to now audit the auditors as AI? We think of it in a positive way, but someone who wants to cover up something, it might be done better, through AI than through their own imagination. So what are your thoughts on that?
Hand it over to Mark.
Yeah, no, I haven't dealt with this specific question, but and I would be interested in Yvonne's thoughts on this because, she is a board member with the oversight responsibilities, but as somebody who advises boards and audit committees, I think when I think about it, it goes to the integrity of the systems and the checks on that. And I can well imagine that, the overall checks and balances with respect to the preparation of financial statements internally and then the auditor's oversight of that is going to be a not insignificant consideration to make sure that there are enough checks in the process that a reasonable person, a reasonable board will be obligated, if you will, to make sure that those checks are in place as part of the fiduciary duties. When I think about board oversight, I think about process mostly and making sure that there's really strong processes that boards can demonstrate that they ask the right questions. They're not necessarily responsible for always finding the needle in the haystack, if you will. But if they didn't ask basic questions that go to the integrity of the preparation of the financial statements and the oversight of that, then they could be liable. I mean, that's kind of the essence of the duty of care with respect to board members. So without having faced that exact question, that's initially how I would approach thinking about that and advising boards and audit committees. But I'd love your thoughts.
Yeah, we do actually speak about this a fair amount every time we get the proposed fees from our auditors. And they're always going up, but they're always investing more in IT. And I'm like, isn't it supposed to go down? But they say they're investing in AI. And what I'd say is that there's a couple things. One is, I think the progression, and again, this is a highly regulated, highly sensitive area. And so the progression tends to be very thoughtful in terms of, where is there high potential value and where's the risk very, very low. And so the first places that you're seeing, not necessarily Gen AI, but AI and machine learning and algorithms play is in a lot of the monotonous work to actually pull the different sources of information to be able to do the analysis. They are using different types of AI to actually help them identify what transactions to test. Where are the anomalies? What is not looking appropriate? They're using it to really help upskill and fast track the development of capabilities of their teams to make the work, quite frankly, more interesting. So, in the previous talk, a lot of things that make it easier for a lawyer to be effective with AI, make it easier for an accountant to be effective with AI in ways that don't create tremendous amounts of risk, but rather, you still have the human in the loop. You still have the sanity check and the oversight, but you're getting a lot of the heavy lifting work done. The other thing that's really important and that we spend a fair amount of time on that's related to this is the infrastructure underneath all of this work. And so there's an increasing amount of work around identity and privileged access management and looking at going from, kind of giving access to roles to giving access to contextually informed activities. So just because I'm a finance person doesn't mean I can access all of NetSuite. I might need to be a finance person and this particular environment is happening where there's something that needs to be entered or done. And therefore, for that period of time, I get access and then my access is removed. So that's one way that we're making it harder for chat bots and other things and bad agents to come in and do things. And then we're looking even further down the path to non-human identities when software and you have all, everybody's agentic now. Okay, great, let's be agentic. You're taking the humans out of the loop. Well, how do you manage that? And so we're starting to look at identities and access permissions for, non-humans who are doing things and taking action. So I think there's a fair amount on both of those sides that are going to help us navigate through this. Will bad things happen? Of course they will. I'd put that in the same box as bad things happen in cyber. Earthquakes happen in California, but you put in place the building codes, the foundations, the practices, the resiliency, the warning systems that you can really help minimize it.
So and I think there's another question there, but Sean Randolph did a very interesting presentation about AI in San Francisco and the Bay Area. For a while, San Francisco and the Bay Area was a little bit shaky. People were saying about everybody leaving to Texas and Florida and pandemic, but it's very resilient. Since 1849, there's been all these crises and people, it's the end of San Francisco, and it seems like AI has come back and saved the city once again. And I want to ask you about the industry because it seems that many of the AI companies are based out here, at least the largest companies, the Magnificent Seven. You think about Apple and Google and Meta are stronger than ever. For the first time, we have 3 companies worth $3 trillion, including NVIDIA, which today was 3.4 trillion and seems to be growing as we speak. And so why don't you comment on, within the industry, how do you see this and the number of, other talented tech people and entrepreneurs and founders? Is it disseminated or is it very concentrated here in the Bay Area? Maybe I'll start with you, Mark.
Yeah, so, I've been at Wilson Sonsini and in the Bay Area for my entire career, so I have that particular lens that I come at this with. This is an issue that we as a law firm think a lot about. When I joined Wilson Sonsini, when I was a summer associate at Wilson Sonsini, it was the year that Netscape went public in 1995, and the epicenter, and I still think it's the epicenter of the technology industry, was in the Bay Area. We had one office in Palo Alto. Now we have offices throughout the world. There is data out there about where the VC dollars go. Still, 40 cents out of every VC dollar is invested in Bay Area companies. So the concentration is still heavily in the Bay Area. New York is second, and they have less than half of those dollars. And I can go on down the list, but it has profound implications for what we do in our profession and otherwise. I continue to think of the Bay Area as the most concentrated center of talent for technologists, whether they be engineers or otherwise, and the support system that surrounds it, including the universities in particular. There is also a little bit of a cultural element that you alluded to over time. I mean, even in my nearly 30 years, there's been waves of technology progression, and I imagine that that's not going to change. And I can't think of a technology wave that wasn't really started here. And that might change over time. There's certainly AI companies outside the Bay Area. I represent some of those, but I think that you'll continue to see the great concentration of technology companies being here. Even the companies that are outside the Bay Area, you find this dynamic where the founder might be outside the Bay Area, but the core engineering team is in the Bay Area just because of how much talent there is here. And even though it's more expensive, that talent really can't be replicated in that degree of concentration in other places. It's possible to outsource, some more rote matters, also outside the United States. But it's remarkable how consistent that conversation is still being had in terms of the just the sheer talent level in the Bay Area. I think that the technology industry has changed fundamentally in that it's not 80%. But it's still very notable in what we do. And if you were to ask me, you know, after being at Wilson Sonsini for 30 years, what is the most important thing that we can do as a law firm? It's be as strong as we can in the technology community here in the Bay Area. Now, I'm just one voice out of 300 and some partners, but you know, I think people who have really thought about that, if we take our eye off the ball, that's to our peril.
Patrick, what about you?
I think what's specifically in the AI industry, there's like a direct genesis for a lot of the founders and a lot of the people who work in the industry from like Google DeepMind and Google Brain, which is their AI efforts. So, I mean, Google has been a leader in the space since 2009, when like nobody was really talking about AI, where it was just a team of 10 people, to today, where it's obviously a very important player in the space, but like, you know, located in the South Bay or on the peninsula, a lot of the founders who founded OpenAI, Anthropic, like go down the list of AI companies, come from Google. So that's like the reason why, and they all live in the Bay Area. So like, that's the reason why like the Bay Area has so much importance to the industry.
That, by the way, is a really interesting comment. You can go back to 1957 with Fairchild Semiconductor and trace every semiconductor company
Exactly.
to the same. And this pattern keeps going on and on. PayPal with all the companies,
Totally.
and now AI is Google in the same story.
And like the next generation will come from
Right.
OpenAI and Anthropic. And I mean, to your point, Mark, that's why it makes sense to continue to bet on the geography. But you know, I think the macro question, which is macro for the entire economy, not just the San Francisco economy, is like, what does an AI business look like? Like, is it still a business that employs 2,000 employees, or isn't it a business that has, you know, 5 billion in revenue but employs 10 people? Like, that's where it's unknown what will happen locally or nationally or globally.
Yeah, I would just add a few things. I agree with all those comments. So I've worked in tech for a little over 30 years and stared at this for a long time. And I think, you know, where people start from is definitely important. I spent a portion of my career at VMware, and I kind of look at the lineage of VMware and the infrastructure space. There's a few other things that I think make this area really special. One is, I do believe, even though we're all a little further along in our career, a lot of the innovation is going to come from the youth who grew up in a digitally native world and just think much more expansively than some of us, because that's how they grew up, and they'll come up with new ideas that we would never think of. And so this is a beautiful and one fun place to live if you're young. I think even more importantly, though, there's a cultural element, which is failure in some regards is success. And you can say that, but until you live it, you don't really believe it. And for me, I took over a drone analytics startup from a founder after 12 years of him running it, and had 14 years of hell, doing down round sales processes, layoffs, you name it, we did it. They had acquired a company in France before I had joined. And anybody who's ever looked at French employment law, you don't lay those people off. And we had a strategic pull out of a funding rounds, and we had to make some really hard decisions. And so we had to shut down San Francisco, sell off the French entity in the IP portfolio. But basically, I had to look at about 70 employees and tell them at the end of November they would not have any more health insurance, because COBRA doesn't exist if you don't have an entity. That was painful. I was in tears. And I had Mark Andreessen write me a personal note saying I'd done an amazing job and he'd be a top reference for me anywhere I wanted to go. I was like, what? And it's because they judge you based on how you handle the cards you were dealt. They look at how do you show up when things get really hard. They look at what type of teams you build. How do you lean into risk? And what I would say is we now have generational experience of rewarding risk taking. And risk taking does not mean you succeed every time. By definition, risk taking means you will fail. And I think this is one of the few business ecosystems that we have that longevity of reinforcement of risk taking. And I actually think that's probably the foundational reason that we continue to be so successful in the Valley is in places like AI, who knows what's going to happen? But you need people who are going to dream, who are going to lean into it and who aren't afraid of failing, because if they fail, they're just going to go raise money and do it again somewhere else better. And so I think that makes it just a really, really core difference from some other places.
Well, you make a very interesting point, because if you're not in the AI industry and in the Bay Area, you're probably doing maybe some layoffs, some down rounds, some recaps, and AI is living this bubble where, well, you can argue whether it's a bubble or not, but the valuations are massive, and it is incredible, and we'll see where it leads. But it is interesting to contrast the AI industry versus the rest, and there is kind of a repricing of unicorns, and there was a height in 2021 of every metric: IPOs, number of M&A, of SPACs, of direct listings, and now things are not going so rosy. But I see we have a question over there. Please go ahead.
So I'm really interested in the corporate governance, Patrick, what you were saying earlier. I grew up in Denmark, which now has the most valuable company in Europe, which is foundation owned. So their corporate governance structure has enabled them to do things for their end user that are not shareholders. And Novo Nordisk is, everyone's happy because they're worth $520 billion, but probably if they weren't foundation owned, they'd be worth a lot more. But I'd like to know specifically, how does your governance structure of being a public benefit company, how does it play into your strategy as a company? How does that factor into how you look towards winning in what you do? And I see on your website, you're a safety and research AI company. And yet, of course, it looks like you have a large language model in Claude. But also, does this affect your ability to raise money from venture capitalists?
Yeah, I mean, I think Mark touched on this a little bit, where he said that you can explore this as a structure if you're a founder, but your ability to actually institute like a different model requires leverage with your investors, right? Like the market will default towards Delaware C Corp unless there is enough demand where you can turn away investors. So that's point one.
Can I make a comment on that? I think about this like dual class share structures. Dual class share structures are shares that founders have been able to have that are multiple voting shares versus the others. And Silicon Valley for a long time has implemented this, where Meta and a lot, Google, the founders have more voting power than the rest. This is like a new iteration of power, but instead of having dual class share structures, you have a public benefit corporation. I don't think it's a perfect analogy, but maybe there is some.
It's actually the opposite, right?
Okay.
Because with like dual class structure, you're protecting founder interest. The founders are trying to give away interest to some degree.
Interesting. Yes.
At least in the context of Anthropic. If it's just a public benefit corporation, I think that investors have less weariness around a
founder
PBC.
entrenchment. Yeah.
But like the anything that like, I think if you were your average AI founder and you were to go to the market and say, I want to institute a trust structure, your law firm would try to talk you out of it, and your lead investors would try to talk you out of it.
Actually, that's a question for you. AI companies, do you have founders with dual class or triple class or quadruple class share structures? Airbnb has 4 classes of shares, if you didn't know that.
Yeah, we do. It's interesting because I see less pressure from the investor community on the public benefit corporation side of it. and that might change over time. There's not a lot of case law in terms of how Delaware or any state actually adjudicates those type of claims. And so I think there's a lot to come on that. Delaware, has always had its default rules of maximizing stockholder value, and you might get some interesting results from the Delaware courts. But when you put into the mix these other interests and how they weight that's something that's to come. But I haven't seen a lot of investor pushback on that particular issue. When it comes to dual class stock structures, and we do see this a fair amount with these bespoke governance structures that I'm talking about. Inflection, for instance, has a dual class or had a dual class
Wait,
stock.
they had a dual class in a public benefit corporation setup. Wow.
Yeah, and that's not that unusual. What I think about with that, and this is a little bit technical, is that the investors, depending on the founder, again, if you're Mustafa, you can put in place whatever you want. If you're not Mustafa and you don't have that type of leverage, the dual class stock structure, and there's an important caveat here, sends a message that you are very focused on control. And so somebody who's not necessarily in position to have the leverage to, make sure that they're financed, I always kind of question whether they want to lead with the control signaling. Because you can put in a dual class stock structure at any time in a company's existence, largely before you go public. That's a different matter altogether. But if you think about it from an investor standpoint, there's not a lot to the dual class stock structure because the investors have preferred stock, and there's exceptions to this, but almost all investors have preferred stock, and they're going to have the control rights that they need. So despite there being a dual class stock structure, if you need a preferred stock vote, you still need a preferred stock vote. So the founder can't override that. And it actually makes stock or common stock voting a lot easier because you just have to go to one person. So, except for that flag of, signaling that you're very focused on control, I don't worry about that too much. And that one issue is not an insignificant issue because, if you're signaling that and you're not sure of getting financing, I'm not positive you want to start with that signal. The board control issue is an altogether different animal. And there, I really think that, a lot of thought has to go into it. Again, if you're Mustafa or you're Elon Musk, whatever, people are going to give you control of the board. But if you're not in that
And when you say
category,
control of the board, so sometimes will a board member get more votes than another? Is
yeah,
that?
you can structure a board so that the founder controls all board votes, for instance, or you can have a certain number of seats and the founder controls the majority of them or has a tie-breaking vote. There's kind of, I wouldn't say an endless number of permutations of it, but there's a significant number of them. That last issue, I think, is altogether different than the public benefit corporation or even a dual class stock structure, because then you get to issues of, is it really one person who, has founder control, for lack of a better word. We spend a lot of time on that. You're probably getting a flavor of some of the things that I counsel folks about in terms of the signaling and things that they need to be aware of. The reality that I see is it's all fine and well, you can put in whatever you want. If the company doesn't perform, it can all get dismantled, right? We put all these things in place and have companies go bump in the night. And sure enough, there's no more dual class stock structure. There's no, control of the board. There's no X, Y, or Z. And so, very few things in life are permanent, and these corporate governance structures are definitely not usually permanent.
So I don't want to go without a question. Sorry.
I think she had a question.
Oh, you have a question?
I think AI is hiding behind PBCs. No other group has gone around saying, we're going to be a public benefit corporation. Why do we need to be a public corporation? Maybe hiding something that truly none of us can participate. Otherwise, I think it's a height of universe. And my other experience with public benefit corporation is actually all governments for the benefit of people.
Yeah,
So I'm just gonna repeat the question and comment just because you didn't have a microphone. The question is it hiding something, the public benefit corporation? Maybe the people don't know about what a public benefit corporation and AI being so powerful, there is a suspicion of what's going on. I think that's, yeah,
That's exactly
okay.
what-
Why do it that way? Okay, exactly, yeah.
Needed a PVC.
yeah. So my experience is that the public benefit corporations aren't limited to AI companies. I have a number of healthcare companies that have elected to be public benefit corporations. And in part, I mentioned that Delaware's default is that you're trying to maximize stockholder value. So in a number of industries, you can even say in most companies, there's a lot of different considerations, and you're not allowed to weight those, from a fiduciary duty standpoint without some override mechanism like public benefit corporations. I understand this suspicion, but if you want to weight, the patients in a healthcare company or the employees or a bunch of other factors, you're not entitled to, I mean, you can do that, but Delaware law doesn't allow directors to give that consideration. And oftentimes, that's a large part of the mix of why people start companies, what they think the benefit of companies are, this limit that you only look at one constituency. And often these companies, as they get larger, there's not long-term stockholders for the most part, right? And so, giving all the weight to a lot of short-term holders of stock, especially in a public company, there's a number of people who question this who are a lot smarter than me and spend a lot of time thinking about these various issues and go into these type of conferences. Is the Delaware default really the right default? But I do have a number of companies outside of AI that elect to be public benefit corporations.
Maybe I'll couple that question with what I want to ask, which is regulation at large, right? So what's going on with regulation? I think last week, SB 1046 in California, there was an attempt to regulate AI by the state of California. The governor vetoed and it didn't go through. And there's a big question mark about how AI is going to be regulated, right? So you can think about your own structure to try to do it for the benefit of humanity, but then you have the state level, the US level, and global, right? There's China building AI, and they probably have a different viewpoint of what are the guardrails around this. And so there's probably a global concern about how to regulate AI. Maybe we'll finish with that, and maybe it couples a little bit with the concern of, is there something suspicious going on here? Patrick, to you.
So on regulation, I think that, we are pushing towards like a more regulated ecosystem. That's like that's and to your question in the back, like why and why a public benefit? What and how does it tie to like commercial interests? Like part of the thesis is like if we do well, and if the only way people will actually acknowledge what we say on the policy side is if we are a leader in the industry. So we need to be successful commercially. With that clout, I think our hope is to influence like regulation that we think will limit the catastrophic harms that could come from AI. So I think like the Biden executive order on artificial intelligence, the EU AI Act, 1046 here in California, those are all good and incremental steps in the right direction that are aimed at addressing like applications of AI that are damaging. I think that that regulatory framework, or what's included in those regulatory frameworks, should just be the starting point. And there needs to be a robust regulatory environment that requires like informed regulators engaged in the industry to make sure that, and that can communicate what risk looks like to the public, meaningfully. In order for like the ecosystem to ultimately thrive. And I also want to acknowledge this is, like this, I think this is not necessarily the industry view. Like there are other players in the industry who would want less regulatory or less regulation. So just like everything else, that will be a matter of like our democratic institution to work out where the equilibrium is.
Well, we've got an election in 3 weeks, so we'll
Yeah,
find
we'll
out.
settle it then.
But unfortunately, we're out of time, and I know there would be 1,000 more questions because it's such a high-level panel. But thank you very much, everyone, and maybe some of you will stay. I don't know, but it's thanks.
Thank you. Great.
So on behalf of UC Los San Francisco and UCLA, thank you all for coming to this beautiful new building. And those of you online, thank you for tuning in. And unless Evan and I are replaced by AI bots, we'll see.
Very likely.
It's possible. We'll see you all next year.